really significant theme over the next 10 years or so. It's already really becoming a big focus here in Europe with the Green Deal, which is putting some money behind this idea, but it's likely to broaden out and provide lots of growth opportunities. So I think that despite the challenges economically, it is fair to say there are some real growth engines and opportunities that are still available for investors as they look to diversify away from the concentration of a very small number of technology names.
Peter, great to catch up. Look forward to seeing you soon. Peter Oppenheimer there of Goldman Sachs. An important conversation, Tom, on the markets, not the Spurs bit, but I know you're dying to talk about Gareth Bale, so let's just do it. Fallen out with his club, Real Madrid, gets paid about 600,000 sterling a week, I think. And the big question now is whether Spurs, if they do get hold of him, continue to pay his wages. Will they pay his wages? Will Real Madrid have to pay a chunk of his wages in order to get him on loan over to Spurs and just get some of that money off the wage bill?
We make jokes about it, folks, but I'm uninformed. John, cut to the chase. Is 31 years old in soccer?
No. I don't think for this generation, people like Gareth Bale, people like Cristiano Ronaldo, who are just pure athletes, who have built their bodies up to withstand pain in a way that I think previous generations couldn't. There's a lot of wear and tear on the body playing football, particularly if you start young. But I think this breed, Tom, have built themselves up and really embraced being in the gym and committing themselves to this career. I think they can have a career well into their late 30s. We've seen it with players in previous decades. And I think Gareth Bale, for him, Tom, it's the injuries around him that's the problem.
Yeah, he reminds me of Roy
Kent.
Not
the age.
I mean, he reminds me of Roy Kent. He's just on Richmond. He's just outstanding.
Neil Dutta, Renaissance Macro Head of US Economics Research, is coming up. You're going to have to explain that joke in a couple of minutes. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Hurricane Sally is threatening the Gulf Coast with what forecasters are calling historic amounts of rain and a potentially deadly storm surge. It made landfall this morning near Gulf Shores, Alabama. Sally is now a Category 2 hurricane with 100-mile-an-hour winds. President Trump is preparing to decide whether to approve Oracle's alliance with Chinese-owned video app TikTok. Security experts have examined the company's proposal. The president has demanded that TikTok sell its U.S. operations for national security reasons. And Federal Reserve policymakers are expected to project that interest rates will stay near zero through 2023. They'll be out with a statement at 2 p.m. New York time. And Chairman Jerome Powell will talk to reporters afterwards. It's the last Federal Open Market Committee meeting before the election. And Amazon wants to make shopping online about as fast as a quick run to the store. Bloomberg's learned that the world's largest online retailer will open 1,000 small delivery hubs in cities and suburbs all over the US. That will help Amazon take on Walmart better when it comes to same-day deliveries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Markets are always too pessimistic about recovery from a crisis. This was no different to previous crises. The markets have failed to understand the speed of the bounce back, the resilience of consumers and businesses in the face of a challenge.
We'll speak to a man who did not believe things wouldn't snap back quickly. He believed they would. That was Paul Donovan at UBS. In just a moment, I'm looking forward to that conversation. In the markets right now, equities have got a lift 12 minutes away from retail sales in America. Several hours after that, you hear from the Federal Reserve and Chairman Powell. Equities up 18 points. We advance a 0.5%. Euro dollar 118.68. Just dollar weakness through G10. Some renminbi strength overnight. And in the bond market, yields coming a single basis point to 0.67%. Don't want to miss crude. Nice lift today, up a little more than 2%. A 39 handle, $39.12, just south of $40. Tom, I mentioned it about a minute ago. I think several months ago it was really hard to be constructive on this economy. There was almost a social stigma attached to it because you sounded somewhat crazy given where the data was at the time. Well, since then, data has surprised to the upside pretty consistently and continues to do so as well. And a small fragment of Wall Street, Tom, you've got to say, they got it right.
John, the resiliency of the market is part of that image of looking forward to what the economy will do is profound. For example, in 2007, when you and I and everybody else went to cash, the Dow was about Dow 13,000. We now enjoy Dow 28,000. One of our great glass-half-full economists is Neil Dutta of Renaissance Macro, and on this day of an important Fed meeting, he, the optimistic one, will look forward. Neil Dutta, how will Jerome Powell frame the optimism the Fed believes in?
Well, I think you'll see some of that, Tom, just frankly in their economic projections, right? I mean, the unemployment rate is lower than where they thought it would be back in June. Inflation is somewhat higher than they thought it would be back in June. And, growth looks like it's coming in a little bit firmer. So you're going to see, I think, just a mark-to-market of that assessment and upward revisions to their forecast. And they wouldn't be changing anything. So despite improving data, the Fed is still quite accommodative and plans to be so for the foreseeable future. It's really just about how they communicate that accommodation to the market. That's really the only debate that's left. And it remains to be seen whether they do that at this meeting. But they're going to stay dovish, and they're upping their forecast. So I think net, that's still a dovish shift, right? Because if the data is improving and the Fed's not changing what they're doing, then that's good for markets.
Neil, we've got to give you a victory lap. We really do. You got it right. You were positive. You were constructive when the data was horrible and we were all dripping, drowning in doom and gloom for good reason at the time. Neil, just walk me through how you saw things evolving, the signposts that you're looking for and the things that have helped you guide your trajectory through all of this and shape a forecast that's turned out to be more accurate than most.
Well, I think you just start from an initial premise of you can either believe, A, America is somehow like this uniquely failed developed state or not. And I don't know, I think not. And there's nothing about the last 10 years since the financial crisis that tells me that Europe is going to come out of this better than we would. I mean, so look, and I think that's the premise I start from. And, you know, to me, obviously the March and April period were very painful. But you know, we're slowly reopening. And the primary constraint, I think, on consumer spending has been a physical one. I mean, if you look at disposable income, because of what the government has done, it's actually higher now than it was in February. So, and if you look at things like deposits at commercial banks, they're still quite elevated, which tells you that, you know, to some extent, people haven't actually spent a lot of the money that they were given to get themselves through the crisis. And now, as the economy reopens, it's very encouraging to see that cases are coming down in most parts of the country. We've had some flare-ups, for example, in college towns and, you know, states in the Midwest. But generally speaking, cases are down, and we do a better job suppressing the virus. That gives us more cover to continue to reopen things in the economy, and you're seeing that across the country. So, you know, for example, in New York, a city that has embraced very strict lockdowns, we're going to indoor dining at the end of the month.
Yeah.
San Francisco's reopening, so that's going to help. There's no doubt about that in my mind, and that will mitigate some of the other pressures we're talking about. So. You think state and local government revenues are a problem now. You think they'll be more or less of a problem a month from now. I'm going to guess less. That doesn't mean that things are good. But, again, I mean, I think a lot of this, guys, is about who you talk to. If you talk to an academic economist, they're going to be focused mainly on levels. And the level of activity in the economy is not where anybody wants it to be. But I'm a business economist. My primary job is just to tell our clients whether I think the growth in the economy is going to be sufficient to continue the upward momentum in equity prices and markets generally, or not. And if that's the question I'm being asked, the answer to that question is yes, absolutely. The economy can continue to motor ahead. And for investors, that means maybe you want to think about going into those names that require people to actually have some proximity to other people, as opposed to, you know, names where you just stream something on your TV in your sweatpants all day long.
Neil, just real quick here, do you think then that the economy is strong enough to not need another round of fiscal support?
I think at this point, for the markets, I don't think it matters at this point. You know, if that's what I determine as need. But in terms of people, I mean, there's no excuse for the government not to do something. I mean, we can borrow money today and pay back less after inflation 10 years from now. I mean, I'm assuming we need there's more of a need for the money today, so we may as well do it. There's no excuse not to, but, you know, I think for now, the pace of reopening is probably going to offset some of the fiscal squeeze people were talking about in August. And remember, you know, folks were looking for this kind of Wile E. Coyote moment in August as fiscal policy tightens. There's a statute of limitations on bearish calls, right? The time for that to have played out has come and gone. And what did we actually see? We saw consumption generally strengthen over the month. It doesn't mean that some people weren't hurt, but there were offsetting factors. Cases were coming down. Reopenings were going up. Incomes were rising.
They're rolling bearish calls. You know that, Neil. They're just rolling bearish calls. There's no expiry date on them.
Well, I mean, then people need then you shouldn't be listening to those people to begin with, right? I mean, at the end of the day, you have to make a call on markets. That's the whole purpose of business economics, tying the economics outlook to some kind of a market's perspective. Otherwise, you know, you're not creating any value for the people that you're.
John, can you imagine Neil Dutta asking questions in the press conference?
I'd love to see Neil there today. Neil's fired up today. I was just joking at the end, but Neil is just fired up. Fire. Neil, great to catch up. Great call this year so far. Neil Dutta there, Renaissance Macro Head of US Economic Research. Really killed it this year, Tom. I mean, we could give a range of shout-outs to many people who just called it right, particularly in the markets.
Yeah.
We had Dan Ives early this week on Big Tech, stuck with it when things were bad. Neil Dutta came on this programme. I remember when we got that unemployment print, in early May, Tom, and it was just ugly, ugly, ugly.
Yeah.
And Neil came out and said it will get better, and it will get better quickly. And it was just so hard to believe him at the time.
That's true. And, I want to make clear, folks, we really keep score of not only who is on plan, on target, on belief, but we really pay attention to what they're doing quarter to quarter. John?
Coming up, Stephen Stanley of Amherst Pierpont, US retail sales, next on Bloomberg Surveillance.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The cybersecurity sector obviously is no secret that it's probably going to do very well in the next 5 to 10 years, say.
2020 has already surpassed previous years' funding in digital health in particular.
I personally prefer to buy businesses that make money, and if you can buy them that are unlevered, that just means they're even cheaper.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Your morning starts right now on Bloomberg Surveillance, live on Bloomberg TV and radio, alongside Lisa Abramowitz and Tom Keene. I'm Jonathan Ferro. Retail sales in America about to drop across the Bloomberg terminal. With the numbers as we await them, it's Bloomberg's Michael McKee.
Well, and that's what we're doing, John. The new system, of course, from the government is everything gets released at the same time. And poor Tom Keene is going crazy here. We're just getting the numbers starting to break here. The August number is 0.6% gain for retail sales overall. That is well below what was forecast. It's half of what we had last month. The gain in ex-transportation, leave out cars, 0.7, also well below what was forecast. Last month we had a 1.9% gain. And the retail sales control group, and this is the one that the economists tend to focus on because it's sort of what goes into GDP, and it shows that it fell by 0.1%. The forecast was for a 0.3 gain, and in July it rose 1.4%. So what we're looking at is a much slower than forecast August retail sales experience, and that may be confirmation of what a lot of people had suspected, that once the $600 extra unemployment benefit went away and a lot of the paycheck protection money ran out, that people would stop spending as much. Taking a quick look at the numbers for the different categories, looking at food and beverage stores down 1.2%. Now, that you wouldn't think would be affected by the $600 because people got to eat, but it may be that they stocked up in advance. The one that a lot of people are going to look at, clothing and clothing accessories, 2.9%. That's a reasonably healthy gain. This is back to school month, so to the extent that people are going back to school and not dressing up to sit at home in front of their computers, there was some gains there. Sporting goods, hobby, musical instrument, bookstores down 5.7%. Department stores down 2.3%. And the non-store retailers were flat, the Amazons and people like that. Food services and drinking places, though, Tom Keene helped, up 4.7%. That's an interesting number because that's real discretionary spending.
Yeah, thank you for that. I think good morning to three guys out on Madison Avenue giving me the eggs every morning. Michael McKee, look, the bond market moves on this in 2 basis points, 1.41 on the 30-year. The 10-year yield comes into 0.660. Maybe we'll see that come in even more. Michael McKee, let's go to the revisions right now. In the not-so-good numbers we just saw, the revisions have a weaker feel to them as well. And this goes to the point where the chart on Bloomberg Radio, we're showing the chart of the 10-year yield coming in as well. Michael McKee put together 2 months of the data being a little bit weaker.
Yeah, you look at retail sales for July, they originally were reported as up 1.2%. Instead, they come in at 0.9%. The retail control group was reported as a 1.4% gain. It is a 0.9% gain. The one thing about retail sales, they are heavily revised. The numbers really capture what happened in the first part of the month. It'll be interesting to see what happens with August as people had less money in their pocketbooks.
Are there seasonal explanations for the weakness here based on the idea that perhaps we're trying to fit the data into a narrative? And I claim I'm guilty of this, basically trying to make it fit this narrative of slowing consumer spending as that extra $600 rolls off. Are there other explanations for it?
Not really at this point. I mean, you would expect to see a bigger retail sales gain in August because back to school. And we did see an effect in July, and I haven't broken it down enough here. Well, here's a number. In July, we saw a gain of 20.7% at electronics stores. So people were out buying computers for their kids. And, of course, a lot of schools did start in August. So we did see a real change there from previous years. This month, only up 0.8% for electronic stores. So that's the kind of thing you would look for. And, of course, apparel stores and the back-to-school shopping season. A lot of people try to look at these numbers to see if they tell you something about what holiday spending is going to be like. I think this year you really can't do that because you don't know the arc of the COVID disease at this point.
Hey, Mike, great to catch you up. Great breakdown. Michael McKee there, international economics and policy correspondent. As retail sales drop across the Bloomberg screen, it is a downside surprise. And for markets, it's always a relative game. Relative to expectations, a rare downside surprise. Here's the price action. Cross asset. Equities holding in there. Still up 13 points. North of 3,400, up 0.4% on the session. In the FX market, the dollar was already weaker. It stays that way through G10. Euro dollar 118.69. But Tom, as you point out, just a little bit of a bid comes into the bond market expected at the long end. That's a flatter curve. 10s and 30s catch a bid. Yields lower 2 basis points to 0.66%.
Well, they come in as well, and the real yield comes in from a negative 1.00 in solid 2 basis points, negative 1.02. To assist us with this, someone writing just wonderful on the American economy, Stephen Stanley of Amherst Pierpont. Stephen Stanley, how do you frame these retail numbers plus the revisions? Does it make you adjust your guesstimate of GDP?
So I'm going to take a tack that none of you have taken yet, and that's exactly opposite of what Neil was saying a few minutes ago, which is I think you have to pay attention to the levels. And the thing about retail sales, and this is an amazing development, but retail sales in July were already higher than the pre-pandemic levels. So we had already more than recovered what we lost in the lockdown. So it was going to be tougher to get big gains in August. So yes, it's a disappointment at the margin, but the fact is that retail sales have recovered amazingly since the lockdowns.
Do you agree with Neil Dutta, Stephen, that the U.S. economy looks strong enough and has enough momentum to not need an additional round of fiscal support?
Well, I think it's interesting. Largely I would agree with what Neil said. I think that it's interesting because everybody was saying that the economy was going to fall off the table if those benefits expired, and of course it didn't. And the markets also were supposedly dependent on seeing that continued fiscal largesse, and we didn't get it, and the markets have kind of moved on at this point. So I think we do need some level of support, I think. It would be nice to get some level of bonus benefits. You know, it would be nice for companies to be able to go back and do a second round of PPP loans, maybe something for state and local governments. But I don't think that the economy, the economic recovery absolutely depends on it the way that a lot of folks were thinking a few months ago.
So, Stephen, you agree with the administration that this is a self-sustaining recovery that doesn't necessarily require another fiscal aid package?
I guess in the aggregate, yes, although I think the way that the Democrats are looking at it is not wrong either, which is to say that even if the broader economy is doing okay, there's still people that need help. And I wouldn't disagree with that. I think, getting help to people who are unemployed, getting help to businesses who are still having trouble, small businesses that are still having trouble, does make sense at this point. But I don't think that the broad macroeconomy needs a $2 or $3 trillion, fiscal booster shot right now just to continue growing.
Steve, the whole idea here of half full, half empty, Chairman Powell's going to have to juggle this today. How do you expect he will express the uncertainty that attends this meeting?
I think the Fed has taken the Fed is somewhere beyond half empty. The Fed looks at every situation and tries to find the black lining in the silver cloud at this point. And I guess you could argue that that's probably the right thing to do, because if things turn out better than expected, then it's great, and the Fed obviously can handle that. But the Fed has definitely been braced and expecting the worst since the pandemic broke. And I don't really see any reason to change that. I think the Fed feels that they need to support the economy in every way they can. And one of the most important ways they can do that is by assuring the markets that they're there and that they're going to provide support. And the markets have certainly gotten that message with an exclamation point. And you've seen that obviously in stocks and in other risk assets.
I like how you put that, with an exclamation point, which brings me to asset bubbles. Do you get the sense the Fed's worried at all about those elevated prices?
I don't. I don't think the Fed has come to grips with the role that they've played in creating inflated asset prices over the last several cycles. And until they, rethink that, we're probably just going to see, kind of rolling asset bubbles every cycle. The Fed is still of the view that they should be easy until consumer price inflation takes off, and it certainly hasn't over the last 20 years or so. And so I think that they're fully on board with the idea that they can be as easy as they please for as long as they want. And if we get high asset prices, that's fine.
Stephen, I asked this earlier on this morning. Chairman Powell is aware of this. He's even talked about it. He did at the Economic Club in New York several years ago when he first became the chairman of the Federal Reserve. Something's changed. What changed? He first had that market test. You remember, I think it was the back end of 2018. Bang, he backed away. Why did that change for him?
Yeah, it's interesting. He's gone through a very rapid evolution over his term as chairman. I think that I think that the Fed Listens tour really had an impact on the way the Fed thinks about things. I think they sat down and they listened to people who normally aren't listened to with regard to monetary policy, people in low-income communities, community activists and people like that, and they have taken that on board, and it's a very different Fed. It's almost like a social justice Fed rather than kind of the traditional thought of a green eye shade, someone that just is looking at numbers and not thinking about some of the more social aspects of things. Whether that's a good or a bad thing, I think remains to be seen, but the Fed is very different, I think, in the way that they approach things today than they were even a few years ago.
Stephen, it's great to catch up. Really, really great. Stephen Stanley there of Amherst Pierpont Securities. Tom, I don't think you can overstate just how much the Fed has changed in the last several years with Chairman Powell, and how much Chairman Powell has changed as well. There aren't the hawks there like there used to be. Plus, a Fisher of several years ago, they're gone, Tom.
Yeah, they are. And, John, to that point, you can literally tell when they get comfortable in the very bright lights and the huge, huge pressures. You can hear their voice change. I heard that with Bernanke. You heard it with Yellen. You hear it here with Chairman Powell. They just get comfortable. They get somewhat comfortable, I should say, with the pressure. And, John, there'll be a lot of pressure at 2 p.m. today here with futures up 12.
Well, I think market participants have got a whole lot more comfortable with this Federal Reserve as well. Equity futures, as you say, Tom, up 12. We advance 1/3% on the S&P 500 on this Fed decision day from New York and London for our audience worldwide. Good morning to you all. This is Bloomberg Surveillance with equity futures up 12. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump is promising that his long-awaited replacement for Obamacare is all ready. The president made the statement in a contentious town hall-style event on ABC last night. He has repeatedly promised his health care plan would be introduced in a couple of weeks, only for the deadlines to come and go. Joe Biden has made his most direct appeal to Hispanic voters yet. Biden made his first trip to Florida as the Democratic presidential candidate, and he told a rally that President Trump has failed the Hispanic community time and time again. Latinos are a crucial voting bloc in Florida, one of the key battleground states. And smoke from the wildfires on the West Coast has now made its way to the East Coast. It's been spotted high in the skies over Washington, D.C. Some of the world's most polluted cities are now in California, Oregon, and Washington state. Air quality readings have soared to the hazardous level. And a new report from Congress rips Boeing over those 2 737 MAX crashes. Investigators concluded the disasters occurred because of sweeping failures by Boeing engineers, deception by the company, and significant errors in government oversight. The report is a template for reforms that House Democrats have been seeking. Boeing says it has taken steps to improve safety. And the Federal Trade Commission is preparing a possible antitrust suit against Facebook. The case could be filed by the end of the year. The FTC has spent more than a year looking into allegations that Facebook uses its powerful market position to stifle competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We do look forward to having people back in the office. What we're looking at is the productivity lift you get if people have the ability to work from home some days, be in the office, in particular when the rest of their team or more broadly teams are in the office. And if you can save people commute time, you have better access to talent because you're solving what people want in their personal life, it's actually going to result in a better outcome. What that means for real estate, we're still figuring out.
That was Ruth Porat there, the Alphabet CFO. Tom King coming up next on Bloomberg TV at the top of the hour, catching up with Bob Michael at JP Morgan Asset Management, the Chief Investment Officer, as we get set up for a Fed decision. And Powell Presser, looking forward to that chat coming up very shortly.
Bob Michael, dead on lower interest rates. Sometime you don't know the why of it, but he has been stunning in his view of lower interest rates. That'll be an important conversation. Futures up 14, yielding off retail sales with a revision 2 months in a row. A little bit soggy. We come in 2 basis points to 4 digits, which we do on Fed Day. 0.6576 nominal yield in the 10-year. This is an important interview. No, not for Lisa Abramowitz or myself, but for David Rubenstein, peer-to-peer conversations, of course, with Carlyle Group. And he's put together a wonderful set of interviews because Ruth Porat is different. She is an academic out of an academic family. Her father was an acclaimed physicist. And maybe more than no one I know has she straddled superior academics with the business world as well. We're thrilled that David Rubenstein could join us this morning. She is so different than she's not just another CFO, David, is she?
She's not. She was the CFO of Morgan Stanley and then was recruited to be the CFO of Google, now is also the CFO of Alphabet. She has been rumored to be a potential Secretary of the Treasury as well. And if there ever is a female Secretary of the Treasury, hopefully soon, she has a pretty good chance of being among the first to get that position.
I mean, they're just superb academics surrounded by experience. How did you take your tack in your peer-to-peer conversation? What approach did you take with her?
I've known her for a while, and I admired her for what she's done. But I wanted to try to get a contrast between the atmosphere in Morgan Stanley, the financial world, and the atmosphere in the tech world, and also how that she's tried to adjust. And I think the interview did do that. She would say that there's obviously a lot of testosterone in both in the financial world and the tech world, but maybe a little more collaboration in the tech world. She would also say that while they have 120,000 employees at Google and then they've been working remotely for quite some time, she looks forward to them coming back because even though it's a tech firm, when you can work collaboratively together, talking to people in the hallways, it does produce better results, she thinks.
David, can you talk a little bit about what the new work environment will look like? She did talk about how she is hoping everyone can get back together in person, but it's not going to be the same, is it?
No, I think most employers, certainly tech employers, recognize that some of their employees can be more productive working at home and remotely, but I think she feels that getting some of them to come back a couple days a week will ultimately be better. So I suspect most tech companies and many employers would like to have their employees back 3 or 4 days a week and then maybe work remotely 1 or 2 days a week, and that would be a good combination for people.
David, what about for you as the head of Carlyle? I mean, do you feel the same, that you're eager to get your employees back to work at this point, whatever it takes, if it's providing them transportation, allowing them to work from home sometimes?
Well, of course, we would like to get back to work in the offices, but we recognize right now there's a lot of challenges because until you have testing that everybody's comfortable with, until you have a vaccine, I don't think everybody will be comfortable. We will begin to open in some offices around the world, but in our main offices in New York or London or Washington, it's going to be a challenge to get everybody back for some time.
David, I've got to turn to business events here, and I'm sure it's something that Ms. Porat has been looking at as well, and that is this remarkable construction of Oracle, TikTok, and some form of the Chinese government. I don't know if you advised on this to any of the parties. I know Sequoia is involved in others, but just your thoughts, please, on this original amalgamation.
I am not involved in it, but and nor is our firm involved in it. But it's clear that Microsoft was interested. It's clear that Oracle came up with a formula that seems to work. But it's an interesting formula because it's not clear that the Chinese are not going to still be involved. So whether CFIUS will approve it, it's not yet clear. It's a very complicated situation, and I suspect it will probably not get fully resolved for some time.
Is it a one-off, David, or does this portend a trend of political transactions?
Well, if there's some political benefit in doing this kind of thing and making these things more difficult for the Chinese to pursue things here, I suspect that we'll see more of this. But we're in election season, and everything is different than it will be after the election. So I suspect between now and the time of the election, this will be the major deal that will get done this way. After the election, we'll have to see. It probably will be different after the election.
David, we've been talking to a lot of analysts today, yesterday. A lot of people seem to think that we're entering a new bull market. Do you agree?
Well, it's hard to say. I would say that after the election, depending on who wins, the market will probably respond okay. But I do want people to remember that we have a lot of debt. And at some point, the market is going to wake up and say, who's going to pay for this debt and how are we going to pay it down? And if interest rates start to go up, that debt's going to be more expensive. So I don't know whether we'll have a bull market or not, but I suspect people are going to look at things differently after the election.
David Rubenstein, thank you so much. With Ruth Porat of Google and Alphabet, this will be most interesting. Peer-to-peer conversation, and as the world turns, you can see this tonight, 9 p.m. in New York, and then Thursday in Hong Kong, 7 p.m., and then on to London, 7 p.m. in London there as well. We have a Fed meeting coming up. Lisa, this is going to be fascinating. Coming off of retail sales, the attendant move that we see in the bond market, it's another a bend, another curve here in the story, isn't it?
Well, the idea here is that the U.S. economy seems to be doing pretty well. If you want to follow the narrative, though, that the removal of some of the additional fiscal stimulus is causing a decline in the recovery, you can look at the retail sales that we got today, and we can get that edified. I wonder how they're going to spin it. I mean, they're going to try to create a scenario where the Fed, where Washington responds, even though things look better than they had previously expected.
It will be interesting, and as I've said all morning, the delicacies of the meeting will be very nuanced. Our Michael McKee, of course, will be there at the Fed meeting, and we've got a wonderful lineup with very varied opinions here on the Fed meeting. Caroline Hyde leading our coverage here. Scott Minerd will join us. The former vice chairman of the Fed. I'm really looking forward to speaking to Professor Blinder of the original economics of the moment with a pulse on the American economy like no one. Diane Swank of the Midwest of Chicago will join us as well. And we finished strong with Jeffrey Rosenberg, who will try to brief Lisa Abramowitz on bonds for the morning. I mean, Lisa, it's really interesting with Jeff Rosenberg to get the dynamics of the fixed income market off this meeting.
Well, bonds have been dead. They have been so boring, Tom, for a while. They've been flatlining. They've been so boring. People are turning to FX to do their trading instead of bonds. And the question is, the Fed wants to keep that. What do they have to say to keep it that way?
Well, or what do they not have to say as well at the meeting? That'll be part of the mystery. Michael McKee, of course, at that press conference with futures up 16. Please stay with us on radio and television. This is Bloomberg.
when everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Kimi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London, for our viewers worldwide, good morning, good morning. The countdown to the Open starts right now with 30 minutes until the opening bell this morning. This Wednesday, equity futures up 15. We advance 0.4%, and we begin with the big issue, looking ahead to the Fed.
I can't imagine they're going to come up with that many new policies.
They're going to stick to the rates policy.
Interest rates are likely to stay in this very near zero range.
Last time the Fed spoke, when they came out and changed their inflation targeting regime.
Why would the market believe that they are able to bring the inflation over 2%?
They just need to back that up today.
They have to do something extra.
Inflation doesn't appear to be on the Fed's radar for now.
The Fed is going to emphasize that improvement that we've seen in the labor market.
It's going to be a lot more about growth and employment.
The unemployment rate is likely to be lowered.
This is always going to be a communication exercise.
Clarify the intent, clarify that you're willing to do what it takes. It's all about credibility. It's all about expectation. We need to hear that from Chair Powell.
In that virtual news conference with Chairman Powell, Bloomberg's Michael McKee, our international economics and policy correspondent. Good morning to you, Mike.
Good morning, John. I'm going to be a little bit cynical here and maybe give you guys something to talk about on your show today. Everybody is expecting the Fed to do something because it's Fed Day, but really, is there anything they could do that would have more than a few basis points impact over a few days? Because at this point, they're not changing rates, and they're not changing rates for a very long time. They'll put out new forecasts, and maybe they'll see the economic contraction not being quite as bad as first thought. Maybe some of them will see a rate increase in 2023. But really, what does it matter that far out? We don't know who's going to be president and what their economic policies are going to be. We don't know when we get a vaccine. We don't know what the arc of the COVID disease is going to be. So the Fed forecasts are going to be very tentative at this point. Now, that graphic we just showed had some issues in it that people will be looking to find out, particularly will anyone forecast inflation over 2% in the long run now that their policy is to let it go there? The other thing everybody's going to be watching, of course, is the dot plot, the old dot plot. Do we see anybody forecasting a rate increase in 2023, and how far do they think it will go? What's the long-run neutral rate nowadays? Nobody really knows, so that's going to be a little bit of interest. And finally, this is only going to come up during questioning, but what's with Fed lending? Right now, the Main Street Lending Program, which was supposed to be the savior of middle-sized businesses, keep people on payrolls, keep them operating, it's a $600 billion program, and only 0.2% has been lent out. You can see the red arrow there. That's where they're supposed to go, but the white line is where they are in lending. Few banks apparently willing to provide the loans. So what might the Fed do to change that?
Mike, can we just bring up the dot plot again, just very quickly? And I'll ask you a very simple question for the people who aren't familiar with the summary of economic projections, who look at that dot plot. What on earth is going on the far side? Why are those dots still up there?
That was the long-run forecast, and I think you have to look at the scale. People were looking at a 2.5% neutral rate, and you had to get there, and you had to get there relatively quickly. There were two people in 2022 who thought the rates would start to rise, but I don't think you can take that at all seriously. The dot plot over the long run has changed tremendously as the Fed has changed its views on what inflation is going to be, or at least if inflation has changed the Fed's views.
Mike, before we let you go, many people have interpreted this shift as a mea culpa over the Federal Reserve, myself included. It's almost like they've admitted they got it wrong last cycle. What's your interpretation of what's happened here?
I don't think so much they got it wrong as they have learned. Economics is constantly evolving. Back in the 1970s, they thought we could let inflation run a little higher and that would bring down unemployment. And look what happened then. But now, after 30 years of declining inflation and no inflation over the last couple of years, even though rates went up and down and rates were at zero for 7 years, I think they figured out that maybe something has changed in the underlying dynamics and they're changing their policy to reflect that.
Mike, thank you. Looking forward to that news conference a little bit later. And a question from yourself, which you won't tell us what that question is right now still. 26 minutes ahead of the session, equity futures just grinding higher, up 15. We advance 0.4%. Here's a man who thinks that this Fed decision might be a non-event. JP Morgan's Bob Michael weighing in on the upcoming Fed decision, saying the following: we expect forward guidance to shift from stabilisation to accommodation of greater growth, but we're unlikely to get details on the only question everyone is asking: how to generate sustainable 2% inflation. I'm pleased to say that Bob joins us right now. A non-event, Bob, is that what you're looking for a little bit later this afternoon?
Yeah, pretty much. I think we're going to get three things that are inconsequential, and Mike McKee went through them. The summary of economic projections in 2023. So unchanged at 0 to 0.25%. Forward rate guidance, yeah, you're going to move from stabilization to accommodation, and likely some commentary on large-scale asset purchases that they're going to shift from market functioning to support of the recovery. And again, everyone's interested. They've moved to this new average inflation targeting framework to average 2%. Well, how are you going to get to 2%? For the last 11 years, everyone has tried and failed.
Well, Bob, do you think they've actually said we're going to try to generate higher inflation, or have they said we're going to tolerate higher inflation if it comes around?
Well, that's a very good question. And certainly when you look at the breadth of monetary and fiscal policies on both fronts, they are trying to generate greater growth and higher inflation. I know there's a great inflation debate raging currently. I think near term you could get a push up in inflation, maybe from the supply shock that exists, maybe from the pool of liquidity that exists. And the Fed is telling us they'll look through that, because when they look over the horizon, they do see bigger issues out there.
Bob, do you think there's anything out there, as far as you can see, that generates high yields and breaks us out of this really tight trading range in 10-year treasuries?
I don't think so. And again, there are those short-term influences that could optically make inflation look high. I don't think the Fed would want to tolerate much higher yield, so they would step in and either increase the duration of their large-scale asset purchases or raise the amount of the large-scale asset purchases. And then once you get through that, then you're left with economies globally with trillions and trillions and trillions of debt layered on top of them. And how we pay that down is going to be the question for the next decade. It's going to take up a lot of economic output.
Bob, we talked about that over the last decade, and then here we are again. Do you think there's something in the story that's changed?
Well, I don't think so on the monetary side. And frankly, if I were Jay Powell at the press conference, I wouldn't wait around for Mike McKee's question. I would say, there's the 2023 dots. I'll be back in 3 years. Drop the mic and walk out. This is all about fiscal policy going forward. And I think what we learned from the financial crisis is that austerity doesn't work. You can't shrink your way to growth. And we learned that in Europe. We learned that to some extent in the U.S. And we need that combination of very accommodative monetary policy, but we need something out of Washington. We need something out of Brussels. We need something out of Tokyo.
Got to put that money to work, Bob. The money in money market funds. You've talked about it a million times, 5 trillion sitting in there and some of it getting squeezed back out. Bob, where's it going?
Look, we, like everyone who invests in bonds, are frustrated by the negative yields. We all wish yields would be far, far higher than they are and credit spreads would be wider. But that's not our reality. Our reality is we're here. There's a lot of money in money market funds, and that money is becoming impatient. And as long as the Federal Reserve and other central banks are creating an environment that's very accommodative, and they're telling us they're going to keep rates low for a very long period of time, that money will leak into credit. So there are things that we do like. We like the corporate bond market as a whole. We like actually the BB muni part of the market. And we also like local emerging market debt. So there are areas of the market where we still think you can generate much higher yield.
So, Bob, you're willing to take some FX risk here?
I am. The exceptionalism of the dollar, I know it's often talked about, seems to be fading in here. The interest rate differentials are gone. We looked at the difference between European investment-grade credit and U.S. investment-grade credit. On one hand, in the U.S., you get 2% on average. On the other hand, in Europe, you get 0.6%. European investors can buy U.S. investment-grade credit and then hedge it back to euros, not take the currency risk. It only costs them 0.75%. They're coming out with an average yield of 1.25%. That's double the yield of the European market. So we are seeing the flows from Europe and Asia come into the U.S. market, and we are starting to see the currency hedges back to their base currency.
Bob, let's build on that as a final question for you. People come to you with a large slice of money, a big chunk of money, and you help them put that to work. Can you just give us some insight, just shine a light on those conversations you're having right now and how they've developed and evolved as the summer has grown older and we push into fall, autumn and the end of the year?
So I just had one yesterday with our European client base, and I tell them to be realistic, that yields are what they are. They're going to be here for an extended period of time. Pick your risk return part of the curve that you want to be on. Whatever market, index, sector you're going to invest in, I think over the next 12 months, you're going to generate the yield on that market or sector, plus a little bit in capital appreciation. I do think yields will drift lower from here over the next 12 months.
Before we let you go, Bob, most important question, just for you and I, maybe nobody else watching. Liverpool, can they do it again?
Boy, that was a real acid inducer over the weekend. Yes, they can. 4-3, they pulled it out in the 87th minute. My bigger question for all of you is, what the heck is Tom Keane supporting Tottenham for? If I were the John Henry camp, listen, John Henry owns the Red Sox, his most favorite team. He also owns Liverpool. If I were the John Henry camp, I would revoke Tom Keane's pass to Red Sox games. Absolutely.
I think they did that a long time ago anyway, Bob, for different reasons. Tom gets a little bit rowdy when he goes to sporting events. Hey, Bob, great to isolate half the audience with you. I appreciate your time. Bob Michael of JP Morgan Asset Management. Some breaking news in the college football world. We'll stick on sports. Here's Scarlet Fu.
That's right, Jonathan. Good news for college football fans as well as college football gamblers because the Big Ten football season is back on. That's according to Yahoo News. The plan reportedly includes daily rapid testing and games will start the weekend of October 24th. An announcement from the league should be coming soon. The Big Ten had delayed the season back in August because of safety concerns from COVID, but now it has figured out a way to move forward. It joins the ACC, the Big 12, and the Southeastern Conference in playing. The only league that is sitting out so far among the Power Five is Pac-12. John?
Scarlett, thank you. As we count you down to the opening bell, 18 minutes away, equity futures are positive going into this Fed decision. Coming up, the latest roadblock in JP Morgan's plan to get more employees back into the office. SocGen's Subhadra Rajappa joins us to discuss the pandemic's impact on the global economy. That conversation is up next. From London and New York, good morning to you all. You're watching Bloomberg TV.
We never thought COVID-19 is going to hit us. But now, looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have second product for approval, and now are actively preparing for the commercialization. And then we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We do look forward to having people back in the office. What we're looking at is the productivity lift you get if people have the ability to work from home some days, be in the office, in particular when the rest of their team or more broadly teams are in the office. And if you can save people commute time, you have better access to talent because you're solving what people want in their personal life, it's actually going to result in a better outcome.
Alphabet CFO Ruth Porat discussing the company's plans to balance employees working from home and coming into the office. JP Morgan also grappling with its reopening policy. For more on that, Bloomberg's Sarah Ponczek joins us now. Good morning to you, Sarah.
Good morning, John. Quite the news day for JP Morgan yesterday in the morning. Reports about Jamie Dimon urging workers to come back. A note from KBW analysts outlining a conversation they had with Dimon about productivity falling with people working from home. Then just a few hours later, Bloomberg reported that the bank was forced to bring some workers home after an employee in that equities trading division tested positive for COVID-19. And the reality is this is just something that many companies are going to have to deal with and grapple with going forward. So right now, where does New York City stand? Partnership for New York City actually completed a survey in the first half of August to ask just this question. Only 8% of workers like you and I are already back in the office. 26% are expected to be back by the end of the year, but a majority, 54%, aren't expected to be back until July of 2021. So next summer, and 28% say there are no return plans at all that have been made yet. So at least in the financial industry, who has the most at stake? Who employs the most people? There you see JP Morgan clocks in at number 3, right in the middle of the pack with about 257,000 workers in the United States. So with COVID, though, a sticking point has really been the division that it's created. Some people can work from home very easily. Other people just don't have the flexibility. And the reality is that a majority of people don't have that flexibility. University of Washington did a survey on this and crunched the numbers. And what they found is that only 25%, you see that orange segment right there, only rely on computers and can do their jobs without much public-facing aspects. So only a quarter of people can actually effectively work at home. And that is where you think of jobs in business and finance, software developing, engineering. And those companies are already asking people to come back. Well, 3/4 of the United States workforce, that's about 108 million people, don't have that flexibility. So still plans very much in flux, a lot of questions. We still have to see what the developments with COVID-19 look like heading into the fall and the winter, but still a lot to deal with here, John.
Sarah Ponczek, thank you. Thank you very much. Let's just get that graphic up again that Sarah used just moments ago on the percentage of people back in the office by July 21, at least in this survey. To see this coming out at around about 50%, that is not the right graphic. That is the right graphic right there. Expected back by year end, 26%. Expected back by July 2021, 54%. Can you imagine what this city will be like if we're only at 54% by the summer of next year? Absolutely remarkable. Sarah, thank you. SocGen's Subhadra Rajappa expecting the virus to keep a lid on Treasury yields. She writes the following: rising infection rates and volatile inflation prints are likely to act as speed bumps on the road to higher yields and steeper curves. But we look for the asymmetric risk for higher yields, especially in the long end, to prevail over the long run. Subhadra joins us right now on the phone for more. Subhadra, fantastic to catch up with you. Can you talk to me about that asymmetric risk that you're looking at?
Absolutely. I think the retail sales number kind of corroborates what I said, which is that this is going to be a recovery where you see, you're one step forward and, I should say 2 steps forward and 1 step back. Broadly speaking, I think if your expectation is that the Fed will not move interest rates into negative territory, then there's really just 2 trajectories that I see for 10-year Treasury yields. One, that we remain range-bound, perhaps between 50 basis points and 1%. And 2 is that we see a steady path to a modest recovery that argues for higher yields over the longer run. I mean, by no means am I expecting, interest rates to rise above 1% this year, but I think next year, as you start seeing more people come to work, like you pointed out, 50% of the New York's workforce is probably going to be back at work. There's a chance we might start deploying vaccines later this year. Under those circumstances, I think that there's a case to be made for a modest rise in yields and steeper curves.
To break out of this range that we've just been stuck in now for months. Subhadra, you and I have had this conversation for a while now, just thinking about how the Federal Reserve might step in and cap that move. How do you anticipate they will?
Well, I think that's a clear risk, right? That if we do see an unruly rise in yields, that the Fed might come in and cap the rise in yields. But, the case I'm making is for a gradual rise in yields and a gradual repricing higher of inflation expectations. I think under those circumstances, I think if fundamentals continue to improve, then there's a case to be made that 10-year Treasury yields should be higher from here on. Just that move is going to be quite gradual because you're going to have this sort of counterbalance of Fed purchases.
Subhadra, walk me through your economic assumptions that underpin this market call, because this economy has surprised to the upside relative to expectations on Wall Street, perhaps with the exception more recently of retail sales this morning. But the path has been pretty clear. What is your base case, Subhadra, that underpins this performance in the Treasury market you anticipate?
Well, just in today's summary of economic projections, you should see an upgrade to growth for 2020 and perhaps a lowering of the unemployment rate. And even by the Fed's own expectations, we're expecting the unemployment rate to reach 5.5% by 2022. So that's a pretty dramatic improvement in the employment picture in this cycle relative to what we saw back in the financial crisis. So, where we know that it took several years for the unemployment rate to get from 10% down to 6.5%. So I think if you see steady improvements in the employment front, as well as a pickup in growth, not just in the U.S., but globally, in the context of much higher fiscal spending, then that should warrant a modest rise in yields over the next year.
Subhadra, in the 30 seconds that I have left with you, just quickly, what would be the question for Chairman Powell once he does everything you've just said they will probably do later?
Is how confident he is that they can achieve a sustained rise in inflation about 2%.
Very
because
simple.
That's something that I think has been very hard.
Subhadra, great to catch up, as always. Subhadra Rajappa, I think everyone agrees with you as well. Coming up on this programme, the analyst action you need to know. That'll be next in our morning calls. And later, Wedbush Managing Director Dan Ives joins us at the opening bout to discuss all things tech, with Facebook and Apple in the news in the last 24 hours. Ahead of the opening bell, equity futures just coming off session highs. We advanced 12 points. We're up 1/3%. You're watching Bloomberg TV.
Census Bureau has asked Congress for a 120 extension. I don't know that you even have to ask, and I think 120 days isn't nearly enough.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Five minutes away from the opening bell this Wednesday morning on this Fed decision day. Equity futures grinding higher by 11, up a third of 1% through 3,400 once again on the S&P 500. That's the price action ahead of that Fed decision and Chairman Powell news conference. Here are some of the morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Guggenheim upgrading Kraft Heinz to neutral, a $34 price target. The analyst citing a strong investor day and improving balance sheet. That stock is up 2% in early trading. Your second call from Deutsche Bank raising its Tesla price target up to 400 with a hold rating. The analyst citing as high expectations for the company's upcoming Battery Day event. That stock at 438 in early trading is negative 2.61%. And your third and final call comes from the team over at Evercore upgrading KB Home to outperform with a $53 price target. The analyst calling it the golden age for housing. Having enjoyed an unexpected surge in demand throughout the pandemic, that stock is up by a little more than 2% at $37.70. And I can tell you there's a housing boom, not just in the United States, but across the United Kingdom as well, outside of London, that's for sure. Coming up on this program, President Trump preparing a decision on whether to approve Oracle's alliance with TikTok. That conversation coming up next with the tech bull, Wedbush Managing Director Dan Ives. A chat you don't want to miss. That's next on this program. You're watching Bloomberg TV ahead of the opening bell. Equity futures positive. This is Bloomberg.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
Tunggu, señor.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
The opening bell, 25 seconds away. Here are the scores. Equity futures positive on the S&P 500 by a third of 1%. The Nasdaq just about hanging on to positive territory, up 2 points on Nasdaq futures going into the cash open. Switch up the board in the bond market as the opening bell rings in New York City. Here's the Treasury market. Yields come in 2 basis points. Retail sales surprising to the downside. Your yield on a 10-year yield, 0.66%. Call it 0.67 a little bit earlier. In the FX market, euro dollar 118.58. It is a weaker dollar story in G10. Throw in renminbi, the Chinese currency stronger, and authorities giving you a little hint, a clue, a flavour of their tolerance for it overnight. In the commodity market, crude up 2.7%, a 39 handle on WTI, $39.32. That's the cross-asset price action going into the open this Wednesday ahead of that Fed decision. Here's some movers at the market desk. It's Bloomberg's Scarlett Fu.
Hi, John. Yeah, and speaking of the Fed, of course, we're not looking for big moves in the major indexes or in equities until after the press conference hosted by Jay Powell. Matt Maley of Miller Tabak has pointed out that in each of the last 4 FOMC meetings, the stock market fell the day after, so on the Thursday after the FOMC meeting, suggesting that the Fed is usually not as bullish or as dovish as a lot of investors had expected going into the meeting. Having said all that, let's take a look at some of the individual movers that are moving right now. We're going to kick things off with the big caps. FedEx right there up by almost 7%, reporting blowout earnings. A 30-cent package surcharge more than pays off with adjusted EPS of $4.87, topping the highest analyst estimate. Keep in mind that this stock before today was up about 164% since the March low. You're also looking at declines in Boeing and Facebook. The U.S. House issues a scathing report on Boeing 737 MAX jet crashes. Facebook is down on multiple reports that the FTC is preparing an antitrust suit sometime this year. No final decision made yet on the timeline. Oracle at a new high. President Trump says he is close to deciding whether to approve the bid to partner with TikTok. Now, going down the size spectrum, Eastman Kodak is also on the move, up 66%. An internal review finds the company mishandled stock option grants to its CEO, but there was nothing illegal that happened. AMC Networks up about 17%. The TV network behind The Walking Dead files a Dutch auction to buy $250 million in Class A stock, equal to about 30% of the Class A total outstanding shares. And over at ADT, a drop of 12% after insiders, including company executives, and Apollo selling shares, 43.5 million shares at $10 to $10.25 apiece. John?
Scarlett, thank you. 2 minutes into the session. There you movers with Scarlett Fu. Here's the price action at the index level. The S&P 500 advancing a third of 1%, lagging utilities, the only sector in negative territory right now, down around about 0.6%. The big focus is on big tech. President Trump preparing to decide on whether to approve Oracle's alliance with Chinese-owned video app TikTok. The president anticipating a decision shortly.
I have a high respect for Larry Ellison. He's somebody I know. He's been really a terrific guy for a long time. So we're going to take a look. I heard they're very close to a deal, and we'll be looking at the TikTok deal with Larry Ellison and Oracle.
Bloomberg's Kelly Lyons joins us for more. Hey, Kaylee.
Well, Oracle is at a fresh record high, as you heard Scarlett say just a moment ago. A lot of optimism clearly about this TikTok deal. Since it first reportedly approached TikTok back in mid-August, the stock is up about 13% relative to just a 1% move for the NASDAQ 100 over that same time frame. That said, this deal is still not over the finish line, John. Still needs approval from both the U.S. and from Beijing. Now, the fact that the deal apparently looks more like a partnership than an outright acquisition. The fact that TikTok and ByteDance will retain control of those algorithms may make it more favorable to Beijing, less so for the U.S., which has pushed for an outright sale all along. Already, we've seen 2 lawmakers come out against the deal. Now, the national security review of this deal has been completed, but no recommendation was made to the president, who is now reviewing this deal. What could work in Oracle's favor here, as you just heard the president say, he's a fan of Larry Ellison. Ellison, as we know, is a well-known fundraiser and supporter and ally of the president. The president said he has high respect for him, though granted, even though Ellison may be in his camp, Oracle employees may be less so. Data from Open Secret shows that they've made far more campaign contributions to Democratic candidate Joe Biden. All of those politics aside, though, John, we do have to consider what happens if this deal goes through for Oracle. While it would serve as TikTok's U.S. technology partner and house the app's data on its cloud servers, it's unclear that it would provide a meaningful boost to that business. One analyst over at Citigroup said they struggle to find a sound rationale for Oracle's interest in TikTok here, as the relationship isn't likely to change the competitiveness of Oracle in the cloud. And our analysts here at Bloomberg Intelligence agree. They say Oracle still has a long way to go before catching up with the likes of Amazon or Microsoft, which dominate 60% of the market, whereas Oracle is so small, not even a top 5 player in terms of market share, John.
Kelly Lyons for the stats. Kelly, thank you. Wedbush's Dan Ives saying the TikTok saga will end with an Oracle partnership. He writes the following: Oracle, as the back-end technology infrastructure vendor for TikTok, will make sure any perceived backdoors to Beijing around data will be an issue in the rear-view mirror. Dan joins us now on the phone. Dan Ives, great to catch up with you, sir. I guess my first question, my only question right now, is whether this is an example of partnership for access that we've got familiar with in places like China that we could see a whole lot more of in the United States in the future. What are your thoughts on that?
Yeah, I think this could set the precedent, especially with Chinese companies. And ultimately, when it came down to it, given the algorithm was off the table, once the export rules changed, a partnership with Oracle was the only way to go. It ends up a Goldilocks situation for Oracle, and I think TikTok and ByteDance not needing to sell, getting a stake, and now they continue to go as a standalone entity. And I think relative to what was essentially a forced sale to Microsoft, this definitely ends up a lot more positive, with Oracle a clear winner.
So, Dan, for me and for many others, they're trying to work out whether this actually helps the bottom line of Oracle. Kelly Lyons talked about it briefly. Will it?
I think this deal itself doesn't necessarily move the needle significantly. I think the ripple effect, especially in the Beltway, as they've trailed AWS or Amazon as well as Microsoft winning the Jedi deal, biggest government deal ever. I think this gives a shot of credibility on the cloud side, puts them more on the sort of area code to get some of these deals. So I think the ripple effect will be positive for Oracle relative to getting this deal.
Dan, stick with us. I want to turn to another story now. The US preparing a possible antitrust lawsuit against Facebook, which I'm sure you've heard about. Freddie Late of Latitude Investment Management saying mega cap tech is loaded with too much risk.
The FTC coming out after Facebook just this morning. A lot of tail risk around the risks they pose to society, the monopoly positions that they have. So I just feel like the risk reward is so much in your favor to buy other high quality businesses as opposed to just mega cap tech.
On this story right now, Sarah Ponczak. Hey, Sarah.
Hey, John, that's right. Facebook is once again in the crosshairs of regulators, and that comes as no surprise. Well, according to people familiar with the matter in Bloomberg reports, there has been no final decision made. Also, this investigation has been going on for over a year now, but reportedly, a case could be filed by the end of the year. Now, less than 10 minutes into the trading day, we did see Facebook shares open down 2%. Since those losses have been trimmed to less than 1%. However, if these declines do hold, it'll be the 7th decline in 9 for Facebook. At the same time, you have to remember, though, that shares are still up 30% this year, even with all this noise going on in the background. Now, the focus of this investigation has really been if Facebook's expansion has harmed competition, particularly with acquisitions of the likes of Instagram, WhatsApp, and also with just Facebook. We continue to see the number of users just move higher. If you look at Facebook monthly active users as a percent of the entire world population, that share is now above 32%. So just about a third of the entire global population, which is quite staggering and pretty significant to keep in mind. Now, at the same time, Facebook is also one of the largest recipients of global internet advertising revenue. Now, admittedly, Google's share is a larger percent of the pie, as you can see here, at more than 36%. But Facebook is a recipient of about a quarter, or 24%, of global internet ad revenue. But more than anything, these latest reports really just remind all of us, remind investors, that these antitrust investigations are still underway, and it is just another lingering risk for these mega cap tech companies, I should say, many with high valuations, John.
Sarah, thank you. Dan Ives still with us. Dan, this is what you've said recently on Facebook, and I want to bring it to our audience. The Facebook antitrust issues are now getting elevated heading into the fall. While a contained risk today, it's a lingering black cloud over the tech sector. Dan, many people have struggled with this, myself included. What are the regulatory antitrust headwinds you need to pay attention to and the ones you need to ignore?
Look, I think right now, in terms of antitrust, the Beltway versus big tech battle royale, I mean, that's going to continue going into the fall. And you're going to see more of these suits, and I think more pressure, especially as the big tech, as the strong have gotten stronger over the last 6 months. Right now, the street views it still as a contained risk. I think a lot of it does depend on the election in terms of potential blue wave and what happens, especially in the Senate, in terms of some law changes. But for right now, it's a contained risk, but something investors need to pay attention to, as there's a bright spotlight on these big tech players where they expect Zuckerberg, Bezos, and others to be spending a lot of time in the 202 area code over the next year.
Dan, just a final question for me, and it's on a company that you've covered so well over the last few years. You've been a committed bull to Apple when others have called the death of Apple repeatedly over the last several years. Dan, the unveil of the last 24 hours, because it's not the iPhone, it doesn't get as much attention, if any attention at all, Dan. And I just wonder, from your perspective, this is real money. And for many people, for many companies, if they could have a segment like wearables, that would be a massive company in and of itself. Dan, your thoughts on the unveil of the last 24 hours?
I think it just speaks to really a broader upgrade cycle, not just for iPhone going into a super cycle, but what you're seeing on iPads, on wearables, on Watch. I mean, Watch, we think it's 10% of overall Apple customers today. That goes to 25% in the next 3 years. You look at wearables and AirPods, that's a $30 billion business. So this continues to be, if you look at the Apple story, I continue to view it as a green light to own this name into a super cycle, which is really a once-in-a-decade upgrade cycle across the whole platform, with services a big part of the re-rating. It continues to be the gold standard that Cook set in Cupertino.
Hey, Dan, love catching up with you. Dan Ives there of Wedbush. Dan, thank you. Coming up on this programme, the pandemic fueling a record year in corporate debt sales. That conversation is coming up next with BlackRock's Jim Keenan. In this market right now, coming up to 12 minutes into the session, equities pushing higher by 0.4% on the S&P 500, lagging materials, utilities, leading communication services from New York and London. This is Bloomberg TV.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
14 minutes into the session, equities grinding higher by 0.2 on the S&P, on the Nasdaq by 0.25%. Just a little bit of a lift on the benchmarks here in the United States ahead of that Fed decision a little bit later and that news conference with Chairman Powell shortly thereafterwards. Companies around the world selling a record-breaking $2.6 trillion in corporate debt, and the year isn't even over yet. According to BlackRock's Scott Thiel, the Fed's effect on treasuries is making corporate credit look even more attractive.
Effectively, the policy implementation has really taken the volatility out of the underlying treasury market, which has been very good for assets like investment-grade credit. We had been very positive on investment-grade credit coming out of the policy announcements because we saw really a very, very powerful dynamic helping the spreads recover.
Bloomberg's Taylor Riggs with us now. Taylor, it is September 16th. I'll double-check that, and we already have a record year.
Unbelievable. You're looking at about $2 trillion in the investment grade market so far this year within the U.S., about $318 billion within that high yield market, really fueling what could be a banner year. Just within the investment grade market alone, the average for the last 5 years is $1.25 trillion. So we've already surpassed that, as you said, and it is only September 16th. High yield there, just a junk bonanza as you take a look at the massive issuance that we've been seeing. Flip up the board and let's take a look at what this means for some of the junkiest of the junk, John. Made this chart just for you. Those triple C's have been outperforming the double B's and the single B's for the 5th straight session yesterday. Triple C's now rallying to about 942 basis points over treasuries. That is the lowest spread since February 26th. As you know, anything below 1,000 basis points is now considered out of distress. But if you flip up the board, it is not just high yield. As I mentioned earlier, banner year for the investment grade market as well. As you mentioned at the top of the segment, you know the story, John. This is the Fed keeping rates low, supporting that investment grade market with their liquidity programs. Investors taking out some extra risk because they know that the Fed is there as the buyer of last resort.
Taylor Riggs, thank you. And thank you for making charts just for me. Tom Keene will be very jealous. Taylor Riggs coming up a little bit later on the close with Romaine Bostic and Caroline Hyde. Looking forward to that later on Bloomberg TV. BlackRock's Jim Keenan saying credit remains well supported, writing, quote, the following: expect some volatility around the election. Investors seeking total return are shifting back towards private markets, anticipating deal flow and distressed opportunities to accelerate over the next year. Jim Keenan joins us right now. Jim, let's just talk about high yield spreads and the stalling we've seen. The lack of tightening that we experienced over the last few months in a big, big way just seems to have stalled out through August. What's your takeaway on that, Jim?
Well, a lot of the total return of the market has obviously recovered here as the markets have adjusted to both the reopening of the markets, the expectations of earnings recovery over the course of the next couple of years, and the massive amount of liquidity that's been put in both from fiscal and monetary response. As you get to these levels, I think a lot of the total return has come out of the market. But as you said, I think they're still very supported. You are still grinding on earnings recovery over the next couple of years. You still have, I think, consistent accommodative policy. And when you think about spreads at 500 over, it's no longer pricing in a liquidity crisis or going into recession. It's pricing in a recovery, and there will be some defaults over the next couple of years in certain sectors, but the market's going to continue to improve. So we think it's well-founded, and it's a place to get carried.
Jim, we mentioned it quite briefly at the top there in the introduction to you about where you think the money seeking total return is going. Can you build on that, Jim?
Yeah, I think obviously you've seen this V-shaped recovery from the markets again as the earnings expectations start to come back over the next couple of years, and I do think that will come to fruition. But when you think about now where the convexity of the market is the upside potential, certainly there are places in equities. When you look towards the credit markets, and I think Taylor touched on where triple Cs have already traded back up to, there's a lot of this is kind of the spread markets are pricing in that recovery. And so we think that it's stable, and you can get a very good excess return relative to what you get in fixed income because of that support. But that being said, there's not as much of the total return or the upside because where spreads are trading at this point in time. So we tend to really like it. But I think from income, in the global fixed income stand, there's not a lot of places to get income, and credit still offers that. But I think what you're talking about is that now that you start to see some of the dynamic shift, I think M&A is going to increase dramatically. I think the private markets are going to be supported, and certainly you'll see investors start to shift back in different ways to get income and illiquidity premium.
Well, Jim, let's add to that. what the money that's been raised is being used for. You know, I sensed around March and April, I think we can all agree it was very defensive. It was simply for some companies just to survive. Do you think there's some confidence out there that there's people now coming to market to raise cash to do things more offensively?
Without a doubt. And Taylor touched on the investment grade. Obviously, in the summer, it was all about liquidity during a period of uncertainty. I think what you see a lot in the leveraged finance markets, high yield and bank loans, is you're still seeing a lot of refi, the shorter tenor debt. So you're seeing a lot of issuance that is coming to refi maturities over the next couple of years. And again, fortified balance sheets. That being said, I think, now people are looking out over the markets and thinking about how to grow. And I do think M&A is going to pick back up. I do think LBO activity will pick back up, and it will remain robust. Spreads are low, yields are low. And if you think about M&A activity or an acquisitions, you can buy cash flows, you can build resiliency, you can get diversification in your business. And I think you're already seeing that pick up.
Jim, just a final question for me, something that I've got really wrong over the last several months, and many of my guests have as well. When we've had conversations about credit, the amount of supply, the amount of debt that's built up on some of these balance sheets, many people, including myself, just assumed that over the next 12 months, once we came out the other side, it would be about balance sheet repair. It would almost be about managing your company for the debt holders and not the equity holders. Jim, what happened to that argument?
Earnings. Again, we are in a recovery period of time, so we're certainly the speed of the recovery. I think, obviously, the data around the virus continues to improve, and there's a line of sight with regards to treatments, vaccines, things like that. But the Fed, the fiscal government, the amount of stimulus that is put back in the market has fueled visibility into the earnings recovery of the next couple of years. And obviously, the debt and equity relationship changes in that environment, and I think that's the biggest component.
Jim Keenan, always great to see you. You're looking well. Jim Keenan there of BlackRock. Send my best to the team, won't you? Looking at this equity market at the moment, up 0.2% on the S&P with your sector breakdown. Back with us, Bloomberg Scarlett Fu.
Hi there, John. Yeah, broadly positive on the day right now, with 8 out of 11 groups in the green right now. We're being led by real estate, healthcare, and industrials. We do want to mention that communication services has stayed positive even as Facebook is kind of falling between gains and losses as the FTC reportedly gets ready to file an antitrust lawsuit. Within the 24 groups, I noticed that transportation is leading the way on FedEx's blowout results thanks to the package surcharges. Now, over the past 5 days, we've definitely seen evidence of this rotation. Real estate investment trust leading the way. Kimco was upgraded to overweight at Morgan Stanley. Materials and industrials also doing better over the last 5 days. And if you look at RRG on the Bloomberg, which tracks relative rotation graph, it's shown a shift for industrials from improving to leading, and materials are also in the leading category. One thing to mention here, though, as you look at these better performers over the past 5 days, is that REITs and industrials are still down since February. Yes, they are among the best performers since the lows in March, but they're still down by at least 6% in the case of industrials, and for REITs, about 10% since the highs back in February. So they have a long way still to go. John?
Scarlett, thank you. Equities advance up 0.25% on the S&P, on a tenth, up a tenth on the Nasdaq. Coming up on this programme, the market-moving events you need to be watching. That'll be next in our trading diary from New York and London. You're watching Bloomberg TV.
Some things you see coming, some things you don't. The trick is to be ready for anything, Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
A fourth day of gains on the S&P 500. Maybe. The S&P up a third of 1%, the Nasdaq up 0.2%. That's the price action. Here's your week ahead, your trading diary, and it starts right here. Looking ahead to the Fed. Before we get there, the Justice Department holding a news conference on national security at 11 a.m. Eastern. The White House holding a press briefing at 1, and then that's that Fed decision and news conference. It all starts just a few hours from now at 2 p.m. Eastern. Democratic presidential nominee Joe Biden delivering remarks at 2:30 p.m. President Donald Trump speaking this evening. Rate decisions from the Bank of England and the BOJ on Thursday, plus another round of initial jobless claims. And finally, on Friday, we get the University of Michigan Sentiment Survey to close out a trading week. A lot to go through before we get there. From New York City and London this morning, good morning. This was the Countdown to the Open. Catch me on Twitter at Ferro TV and look ahead to the Fed decision in full with coverage coming up on Bloomberg Television and Radio. This is Bloomberg.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things, they're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
That's where they are right here.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He's all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of in life happens. You know, I'm here by myself. So ¿dónde vive acá? En la parte de This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each
other? There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a Juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger. And without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen $1 trillion loan program?
I have not.
How about $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
that moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty.
The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks, and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, US Navy, and other branches of the US government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
2 traffic, 260. Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats could face real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. election.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to USA, 24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国的脑袋绝不比你们差。我们在座的所有的一个脑袋绝不比你们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different?
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Valleywag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The US was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the US commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and US states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lite-Brite comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I've learned so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it, and we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, it is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
It's a bit like an addiction. You've got to make something, you have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Sven Cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice, you've got to be able to judge material temperatures, you've got to just look at it and you just get a feel for it. It's a stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, and you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched, you have symmetry in the colors and texture of the wood. Cut your outline. take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There is a lot of time that goes into these boards, between 40 and 60 hours, start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table, once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven. Get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己，我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
Even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊，我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话，去改变他们的想法。我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力 ，Blued 能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同志互联网公司。
This is Rich Chigga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of like predominantly Asian artists, you know, really like making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but like for what was the question.
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness, residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here was kind of like my own kind of private office, basically. Like, to be honest, I would even go to the bathroom here. I would like take pisses here, you know what I mean? Like, it was, you know, it's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy. And like just the shit that he was saying, like the memes he was making. But I didn't know that he rapped or anything like that. I really didn't. And he came up with Dat Stick like 2 weeks later.
12 in the morning, pop shells for a living and baby gon' smell blood trail every minute road.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just like everything about it, man. Just like, it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chigga on my phone, Rich. Brian, he gets like super pissed off that he's saved in my phone as Rich Chigga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I did the sound check.
How was it?
It was tight. Hold his stick blocks, but you been a bitch, suck a thick cock.
So, Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chigga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier, you know, and it's just more entertaining. We just edited it as tight as possible, put it up, and
it really worked.
12 in the morning, pop shows for a living in.
Yo, this nigga got a pouch on and a Reebok pouch. This is the hardest nigga of all time.
You said when you come for a trigger like me, that was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I had never been to America before, and like all of a sudden, it's like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral, and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chigga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it, like who cares? We were like, okay, let's just go crazy at the drop. So that video goes up, I go to sleep, and the next morning, everyone's doing it, like next morning. Do the Harlem That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this,
It's just Taco Bell, what could possibly go wrong?
to creating something like this, the newest music video for his song Demons.
The demons told me everything, they whisper in the night. This is not a threat, I promise.
Tonight, Rich Chigga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. I was the third person online.
So why'd you get here so early?
Because I want to see I want to touch him.
What do you guys think of Joji?
He's
That's my dad, son. Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But 88 Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for 88's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store when customers touch and feel products? And we created a concept called the Connected Rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror. So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards.
Do you want me to turn you so you're looking outwards? Yes, please. How about there? First time we came out with B, Jade said, it feels like I've been released from prison. Do you want these, missus?
Definitely.
Definitely. Right. Yeah. And she could say hello to everybody, people she hadn't seen for months.
It's
Hi,
Jade.
it's Jade. Oh.
So you can talk to Jade through this.
Hi, Katie. She's there.
Hi.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look. Hiya.
When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. have a condition called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time. A lot of the time with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Yeah, me too. Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign, is incredible. Or being able to have that kind of chat in the car that most people would probably take for granted.
We're going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in a house with just her carers. It's quite a small world, that.
Right, so there's one of her. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do.
Was that? Good.
It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go to those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably.
He's written it out bigger on the board. Thank you.
Today's the first day that I've been in school via B, and so far it's interesting. Still a few little things that we need to work out, but for the most part I think it's going fairly well. And it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well and I was really tired afterwards and ended up having loads of seizures, whereas today I've been able to do all of the work, I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify root 8. The algebra test is next week.
Now I'm trying to make friendships which I'll be able to maintain with B. Before that, I end up letting people down quite often. B gives me hope, yeah. She's just always there, and if I can't do something, she can. And if I need sort of assistance to be able to make commitments, then she's there, and she means that I feel like a more valuable person because I'm more reliable.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
The cubicle represents a tyranny. It confines your imagination, your thoughts, into a small physical area. Imagine pretty much every software engineer or finance person being able to, disconnect from their desk and look at holographic monitors on a beach and doing their work from there. That's not going to be science fiction. It's the modern office place.
Silicon Valley is all about building the future. A startup called Meta thinks it's getting there first, thanks to a big bet that it's made on augmented reality.
How are you?
Good, thank you. Welcome to Meta.
Thank you.
Call it a 360-degree office where you can spatialize your thoughts as part of your workflow for education, architecture, design, engineering, etc.
People often mix up augmented reality with virtual reality. VR totally blocks your ability to see or hear the real world. AR overlays holograms onto what you already see. Meta has tried to make its version of the workspace feel familiar.
You grab the hologram instead of using a controller or a mouse, and your brain already knows how to do it. In other words, we've designed an operating system that humanity has always known how to use. So you can see this eyeball, which is, by the way, photorealistic. You can see my hand is occluding the eyeball, and now the eyeball is occluding my hand, right? You see those two circles? They get small, and then they turn into this glowing white ball, and then I can move my hand around supernaturally. I can do this with two hands and rotate the thing. I can stretch it. I can throw it back right into the shelving system, and that's all you have to learn to become a modern worker.
And to prove this, the employees at Meta have started to get rid of their computer monitors, trading them in for Meta's augmented reality headsets. Meron thinks that in less than a decade, we'll all be just wearing strips of glass that can project holograms.
In the early 80s, everybody had computers on their desktop, but no one was using them because they had a lot of work to do. So they were still using typewriters. And at some point, the CEO took all the typewriters away and everybody was forced to use their computers. So it's very exciting to see a new generation of technology, a new paradigm.
I consider us like pioneers in the holographic wild. I'm pulling up my browser with my hands and sending out emails to colleagues and just kind of really acclimating to the new environment.
Now you're putting on my computer, essentially. Our digital lives live on our phones. We have all of our pictures and notes and all these kinds of things. So why don't you write yourself a little sticky note? I like it. And go ahead and just take your fist right over the top of the sticky note and close your fist. And now...
Oh, what?
Meta's own transition to augmented reality has run into plenty of unexpected problems. And it's still going to be a while before you'll start to see these devices in your office. But I think it's a future worth waiting for.
If we could see these holograms between us, we will have been able to share our work with one another more naturally, more efficiently, and more productively than ever before. Humanity will have evolved slightly.
This is Hatsune Miku, Japan's sensational virtual pop star. She's released over 100,000 songs in multiple languages and performed sold-out concerts around the world. Her image has appeared in games, on TV, in car races, and is even etched on the side of a Japanese space rocket.
I came from Hatsune Miku, Carlos.
She's Lady Gaga's favorite digital pop star and opened shows for her in the US 3 years ago. Tens of thousands of fans attended her exhibition and live shows near Tokyo recently.
理想のアイドルっていうとどの曲でもミクはすごい綺麗に歌ってくれる。
他没有缺点啊，没有任何让我们感到不开心的一些新闻。
She's everything to everybody. That's probably why she's so popular.
Miku's creator Hiroyuki Ito and his Sapporo-based company have been developing the virtual diva for over 10 years.
初音ミクとはキャラクターとしてすごくYouTube とかで検索するとたくさんの初音ミクが出てくるんですけども、元々の初音ミクのその原点は歌声を合成するソフトウェアなんです。
Both the software and character are named Hatsune Miku, meaning the first sound of the future. Originally based on Yamaha's Vocaloid technology, Miku the software has a sound bank containing voice samples and a huge array of tools. You input the melody and lyrics, then Miku the character sings them.
Happy birthday to me. Happy birthday.
To date, Krypton has sold 120,000 software licenses at $200 each to fans around the world who use it to create numerous songs and share them online. Some of the fan-created songs are chosen to be part of Miku's concerts, for which they're paid a royalty fee.
もともと初音ミクっていう存在自体がボトムアップって言いますか、中にはアマチュアクリエイターじゃなくて今もうすでにプロになって活躍している方もいらっしゃるんですけども。
The company also has other revenue streams. It makes money from merchandising, licensing deals, and concert ticket sales. According to the real-life musicians who perform with Hatsune Miku, the virtual pop star is interesting and surprising.
今年で3年ぐらい、ちょうど3年ぐらいやってきて、ライブも数十本、数百本やったの。そういうことが演奏によって起こせるためのそういう器みたいな感じになってます。初音ミクらしさって僕はあんまりない。初音ミクって何だってあり。
For Ito, Miku has the potential to change the way we think about music.
そういう新しいテクノロジーによって新しい音楽のあり方っていうものを模索していきたいと思っていました。
And for her fans, it goes even further.
初音ミクって魂がないので、だからみんな魂を作り上げるために存在しています。
Now, there are a lot of fitness gadgets out there. In my quest to get fit, I tested 17 of them over the last few months. At least one personal trainer I know was a little bit skeptical.
Yeah, I've been watching these new technologies come to the market for almost as long as I've been a personal trainer. They're just tricks and tropes. They're not much different than the Bowflex machines or, to be honest, the original Jane Fonda workout video.
But some of these gadgets that are just coming to the market do so much more than what they used to do, just tracking your activities. Out of all of them, this chest strap was my favorite. It comes with a robot coach that points to the future, one where you might not need a human trainer at all. And it works like this. You wear the chest strap so that it can read your heart rate, and that connects to Move's free app that talks to you.
Welcome to Move Heart Rate Hit Outdoor Running. Let's get moving and warm up in Zone 2.
Move's computerized coach tells you what to do at that exact moment, whether you're running outside or you're doing body weight exercises indoors.
Swing your arms faster to get your legs moving quicker. Let's crush this round.
And by reading your heart rate, she knows exactly how hard you're working. She keeps you honest.
Way to go, you are in the target zone. Keep pushing, you're almost at the end of the round. Don't give up.
I've been running for 7 years now, and my biggest problem is that I never push myself hard enough. I end up going on the same slow, comfortable 30-minute jog, but the Move HR Burn blasted me out of that rut. By the end of these half-hour exercises, I was drenched in sweat in a way that I never am when I work out alone. Training with a real person is great, whether that's your group instructor or your coach or your personal trainer, but humans, they're expensive. For the rest of us, this $60 gadget is all you need.
what does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, US Navy, and other branches of the US government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
2 traffic, 260. Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the US government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims,
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
I'm about to expose everything you won't admit. And action! This entire video is based on a true story. When I do like motivational speeches or even tell myself like, love yourself and you should love yourself.
This is Lily Singh, but to fans all over the world, she's the YouTube star Superwoman.
What if everyone is a girl, superwoman? I know we can change the world for the better, one positive day at a time.
My parents now know what I do. They didn't know what I did for a long time in the beginning of my career. I was just making videos in my room. They had no idea.
Mom, Dad, have you seen my keys? I can't find them anywhere. Because you're always on phone.
Until someone called them, like a family member from another part of Canada, was like,
Canada,
is your daughter making videos? And I think my mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're going to go to school and then graduate and then get married and then get a job and have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010 and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe, and my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oi Lily, where's the rest of your skirt, huh? I teach you like this to walk around like this, showing everything to everyone?
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's a real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman.
What up everyone, it's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about like, I will save guys with my superpowers and I will save girls with my superpowers and I am the Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name.
Maybe this should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She started a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up!
But after surpassing those goals, success has new meaning.
I really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views and the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.
CTE is often found in the brains of deceased athletes, military veterans, and others with a history of repetitive brain trauma. Hundreds have donated their brains to the VA Boston University Concussion Legacy Foundation Brain Bank.
This is a former NFL player who died in his early 70s, and this is a veteran who also died in his early 70s.
Dr. Ann McKee dissects these brains.
The hippocampus and the mammillary bodies are very important for memory. I can see that they're slightly affected.
McKee recently dissected the brain of former New England Patriots player Aaron Hernandez, who was convicted of murder and later committed suicide.
You'll see right away that the brain is showing signs of shrinkage. You can see the crevices in the brain that you can't see in the normal.
McKee says Hernandez's severe case of CTE impacted his decision-making, depression, and ability to control rage and aggression. Right now, she thinks we're underestimating how many people have CTE.
We were able to distinguish between CTE and controls and CTE and Alzheimer's disease. The next question is, can we do this in the blood, and can we do this in living people? And we aren't there yet with those answers.
But the need for a diagnosis in the living is motivating companies such as Quanterix in Lexington, Massachusetts, to work faster on technology that could diagnose concussions and CTE in as few as 30 minutes. Kevin Rosovsky is the CEO.
It's like a high-powered microscope. And so by doing that, we can see little biomarkers that you couldn't see before in the blood.
Quanterix received a grant from the NFL and just went public. Since then, its stock is up more than 40%. The company sells a machine called Simoa for $175,000 to other biotechs, hospitals, and researchers.
And for the first time in history, we're able to see brain health in blood, and that's a major breakthrough, and that's leading to less invasive testing, and we've already been able to see evidence of concussions, and there's the beginning evidence of being able to see the accumulated effect of concussions.
Quanterix is also trying to detect Alzheimer's disease, multiple sclerosis, and ALS. Rosovsky says he thinks diagnosing concussions will be easier than diagnosing CTE.
Diagnosing CT in the living probably is a couple years away. We're real excited to see the progress, but reducing some of that work into actual tests in a laboratory takes time. There's regulatory approvals. There's a lot of red tape that you have to go through.
Also in this race to diagnose CTE in the blood are Athlon Medical and Exosome Sciences. And New York's Mount Sinai Hospital is scanning for the disease in the living. But it's just one step in a series of questions for those with serious head trauma. There's still no cure for CTE.
Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Vinous.
Antonio, tell me, what are you trying to build at Vinous?
Well, at Vinous, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Vinous is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime. And Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. It's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that 1 or 2 people will actually have more influence than Bob Parker did. Because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, nobody will ever beat this record. And then somebody comes along, it's like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have 2 guys who are ahead of that and 1 knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. That was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company. And that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! It's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag #GiveDivas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music. And their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves ahead.
Dara, thank you very much for coming here.
Thanks for having me.
I've always been relieved ever since you were appointed, because at least until your appointment, I seem to have the most unpronounceable name. But now we will keep it as Dara and John. This conference is called The Year Ahead, but in your case, you are close to 6 months into the job. And I wondered what you saw in terms of the year ahead at Uber as your biggest challenge. What's the thing that you think about most when it comes to 2018?
We definitely have our share of challenges at Uber. And for me, where I want to get Uber to the year ahead is a year of normalcy. 2017 was, I think, will go down as one of the most difficult years for any company out there. And I have to give credit to the Uber team and the employees there. It is a group of true believers who believe in our mission, who believe in mobility as a service being available to consumers everywhere at a reasonable cost. And what my job in 2018 is to get rid of the distractions and get the company back to business, get the company back to normalcy. There's a lot that we've done in the past 6 months as far as bringing in new investors, driving a new culture and norms where doing the right thing, period, comes first, bringing a new management team, et cetera. There's a lot that we've gotten done, but this is a company that knows how to execute. This is a service. Mobility as a service is something that's universal, that's needed in the world, and I just want to get back to doing business.
It's quite interesting. You said true believers. Yeah. Normally, true believers are the last possible people where you're able to change a culture. Can you explain a bit about that?
Well, I think that they understand that mobility as a service, bringing the cost of transportation down, making transportation services available to anyone and everyone on a local basis, and partnering with cities to be a solution to traffic, to pollution, etc. That is a mission that they all believe in. And I think that they, having seen what happened in 2017, to some extent the crisis, the enormous crisis that the company has gone through, is a benefit because everybody at the company knows now that we need to change, that we need to break with the past as far as the way the company was run. We need to go from growth at any cost to responsible growth and growth in partnership with other players out there. That's clear, but now I've got to kind of get the company down to the normalcy of execution, of building great technology, and I think we're going to get there. It's still some tough sledding early on, but I absolutely think we're going to get there.
When you talk about execution, is profits one of the things you want to get? I think you lost $4 billion last year.
Well, profits,
peanuts by the standards of...
Profits would help. Yes. So at some point we absolutely have to become profitable, and that's part of the plan.
Do you have a kind of goal for that? Do you think you should be profitable by 2022 or by 2020?
I think that we'll be profitable before 2022. This is the business itself.
Do you want to come back a bit closer, 2020?
Yeah, listen, it's not going to, I don't want to name a specific year, but this is a business that the core business, the ride-sharing business, can be profitable within 3 years. We will continue to make very aggressive investments in building out autonomy because we think that's a terrific opportunity for building out new technologies such as Uber Elevate, where near-term profitability is not a goal, but long-term growth is. So we will look to balance near-term profitability, but as a company, we will always be a company that makes big, bold bets and takes big risks.
To what extent, though, do you think that drive to become profitable fights against a little bit of this culture change? If you want to make, you talked about making money, but not at all costs. Do those two things?
Well, I don't think that profitability and culture are their issue. It's the company in the past was willing to make trade-offs as it related to how it did business, and I think was guilty of hubris, was guilty of thinking that they knew better than others, and I think that what we know now clearly is that breakneck growth can hide cultural issues, that there are no excuses for not doing the right thing, and that you do have to make trade-offs. And as a management team, we're specifically talking about those trade-offs that you have to make. We have to be a little more patient sometimes because working with governments, regulators, etc., sometimes takes longer, but in the end, you build a more lasting business. And so maybe what we went through was necessary, but we're here. We can control our actions from this moment onwards, and I think everyone at Uber from this moment onwards wants to build a great company, not only in terms of growth, but in terms of the kind of company anyone would want to work at.
Can I ask you one thing which you have got a sort of hangover from last year, which is all the regulatory problems, and particularly all the cases against you? I think there are 6 criminal probes or whatever going on.
The lawyers are lining up outside the door.
Which one do you sort of think? Which one do you fear most? I suppose out of these different things.
Listen, I think that all of them are serious issues, and my response is that we're going to be transparent and we're going to take responsibility for our actions in the past. I do think that there are certain circumstances where there was smoke but no fire, and I think as a company we have to defend ourselves and work within kind of the appropriate frameworks. And my goal is just to get beyond this stuff.
Some of these things like pricing policies, surely they go right to the heart of what Uber is, or am I wrong about that?
Yeah, I think they do, but I think that there's a way of being smart but transparent at the same time, and that's where we've got to take the company.
Take me through governments. When you talk to governments privately, do they talk any differently than they do publicly?
Governments?
Yes, governments.
I think that they are honestly a bit relieved with how we are engaging with them, because I think that the engagement is now real. I think they feel like we're out there, we're genuine because we've learned our lessons of the past, and I do think that we can take, for example, the data that we have in terms of traffic and in terms of movement of our drivers and riders, and we can use that data to partner up with cities in order to solve congestion issues, because congestion doesn't help anyone. It wastes enormous amounts of time for consumers. It hurts the environment. And I think that we are aligned with cities, for example, to partner with them in a fundamental way to solve these problems. And I do think that when these are conversations that a number of regulators and cities have wanted to have with us for many years, and I think we are really engaging with them at a depth that I think is going to create a real win-win going forward.
Do you think you were too confrontational on this before?
Yeah, I do. I think that the company was pushing growth. And listen, any innovator, to some extent, the innovation is about questioning past kind of present practices. It's about breaking things, the Facebook breaking things. We just went a step and a half too far. And what I want to keep, hopefully, is the best of both worlds, which is this spirit of innovation, the spirit of can-do, etc., but the responsibility of partnership. We don't know better than you. We're actually going to work with you, of actually having dialogue and respect for our city partners, for regulators, and then continuing to take risks and continuing to do daring things. And I think we can accomplish that.
Imagine this audience here is a collection of mayors or a collection of city officials, and you want to depict, this is the Year Ahead conference, depict what the years ahead in this thing are going to be like. How far is driverless cars going to go? You talked just a few days ago about the idea of there being flying cars in 10 years' time. Can you just give a description of what you think transport is going to look like?
Well, I think that we think there are three keys to transport and where the industry is going: autonomous, electric, and shared. And I think all three are necessary in order to get to the next level of city planning, et cetera. There are many cities where up to a fifth of the space taken in these cities is taken by parking and storing these cars. And so I do think that you need autonomous, you need electric, and you need shared. And I do think it's going to take some time. True autonomy for every single use case is some ways away. What we bring to bear is our developing autonomy, and we will have autonomous cars on the road, I believe, within the next 18 months, not as a kind of a test case, but as a real case out there. And over a period of time, we're going to bring autonomous transportation and feather it in with the non-autonomous transportation with drivers.
What does feathering in mean?
Feathering in
means to a layman like me? Crashing.
Yeah, feathering in means if you're, for example, in Phoenix, and you make a request to go from A to B, which is what you do with Uber, there will be 95% of cases where we may not have everything mapped perfectly, or the weather may not be the right weather, or there may be an accident on the road, or you may not have 2 or 3 ways of getting from A to B, where you may say, you know what, that's not an autonomous use case. We're going to send a driver to pick that person up. For 5% of cases, everything is going to fall into place. And we will send an autonomous car. The user will be able to pick, do you want, there's an autonomous car, yes or no? And we'll be able to service that A for B. That 5% is going to go to 10 and 15 and 20 as our computers and our algorithms learn more and more about what it takes to drive in a city in a real life situation. And every minute of every day, that driver, that computer, is going to get better and know Phoenix better and better and better. And in 5 years, we'll have the perfect driver in Phoenix. We will have to retrain that driver in every single city. We're going to have to build out 3D maps of these cities. And it will take time, but over a period of time, you essentially have a driver who becomes the perfect driver. It'll take 10 to 15 years, but that's the feathering in that I'm talking about.
And will a child born today, will they ever need to learn how to drive?
A child born today? No, I don't think so.
So within sort of 20 years from now, we will...
I don't think so. Listen, I hear some groans.
And also...
I heard a couple of groans. 1.3 million people die from car crashes every year. 1.3 million people die from car crashes every year. That doesn't count an estimated 20 to 50 million people that are injured. Okay, this is actually a public safety issue. If you look at cars, 96% of cars... 96% of time, cars are sitting there not being used. It is a huge amount of pollution that's caused by these cars being in the road, and a huge amount of wasted time. So the safety is there. Electrification is absolutely key, and sharing these platforms is going to allow us to be much safer and also put our assets where they add value.
But it's quite interesting because when you first came in, I remember you sounding somewhat more skeptical about self-driving cars. You've been converted. Is that a?
The choir has spoken, and I'm listening. It's pretty exciting technology out there. But again, it will be a hybrid technology for some period of time.
What about flying cars? That came as a slight surprise.
Yes, that's a great project that we're working on. It's called Uber Elevate. And it is actually about battery technology.
It would have helped a lot of people here.
I know. I wish that I was available. We'll launch it here if we can. But battery technology is allowing us to have multiple rotors on planes, or helicopters, if you want to call them that. These rotors that are much smaller will be much quieter than helicopters are. Much quieter, much safer. If you add sharing into the equation, you can actually get the economics of going from A to B. We think within 5 to 7 years to a place where normal people would think about taking these flying cars. That'll be the beginning, and then it's about scaling. And we're working with a number of partners right now.
Do you think the regulation on flying cars? I've heard some proponents of it argue that it might be easier than it has been on driverless cars, because driverless cars you have to deal with existing roads, existing everything. Flying cars, essentially you're going into unconquered space.
I think that mayors that are forward-thinking understand that traffic and pollution are a real issue, and I think flying cars can be a significant solution to traffic issues in cities. And these cars, to start with, they're going to be very specific. They'll be kind of highways in the air. There'll be very specific routes that these flying cars go on. They're not going to be able to take you to your backyard and land in your backyard. There'll be these skyports. So there'll be very specific routes that you go on. And I think if you build a regulatory framework that has that kind of structure around it, I think you get to a better solve.
Can I drag you back somewhat reluctantly back to the real world? But you have Rajiv Misra, who came in with you from SoftBank.
Yes.
He's going to become a director. Last week he said that Uber should focus on repairing its market share in the US and on key European markets rather than going to new ones. Do you agree with that? Is that the way you look at Uber?
I think one of the fundamental strengths of Uber is the global scope that we have. This is a brand.
Had that motto, everywhere. What's it? Everywhere for everyone.
Yeah, everywhere for everyone.
Do you want to make it some places for some people?
No, we like the everywhere for everyone. It's much sexier than some places for some people. That's
telling me.
Just not interesting. I do think seriously, though, that the global scope that our company brings is important. Our being able to build technology that we can amortize essentially everywhere in the world is hard. but it is part of the fundamental value that we introduce. So I would look at Uber very much as a global brand. That said, we're going to look at all opportunities, but at this point we are leaning forward, and 2018 for us is going to be very much a lean forward year for the company.
But without, I'm not trying to create new boardroom tension at Uber, but that would appear that SoftBank is keener on a more limited idea, whilst you're keener on everywhere for everyone.
Well, listen, SoftBank is a very important shareholder. They're our largest shareholder, and many of our shareholders have opinions over what's the right thing to do. Ultimately, the governance of the company is going to be at the board, and we'll have those discussions at the board, and we'll set our long-term strategy and then execute on it.
One of the things which Uber played, perhaps not very fortunately, a role in was the whole sexual harassment questions and everything to do with that. I suppose one very obvious question, do you think that you have solved that part of the culture? But secondly, do you think that this is a real revolution and it's going to stick?
I think that what was happening at Uber was serious, and I think that while what Uber went through what was difficult, I think the Susan Fowler blog was probably one of the best things that happened for Uber, and it certainly started a movement that's an incredibly important movement of the company. I'd be reticent to say that it's solved.
Yeah.
But it's not an endemic issue within the culture of the company, and I think the company has learned, and I think the company took very harsh and appropriate steps to make sure that kind of behavior is absolutely clear, that kind of behavior is not accepted in any way, shape, or form of the company, regardless of where you are, regardless of if you're a great performer or not. So I think we're at the right place for Uber as a company, but I think in general, we're not where we need to be in terms of women in senior positions, making sure that we're welcoming of women in technology, and we help women really build their careers within our company. There's a great kind of bottoms-up energy there, but we're not where we need to be, and we have a lot of work ahead of us.
On the issue of, you talked about the top performers, is that looking back, and also I suppose looking forward for many of the people in this room, because there are a lot of people's businesses which have been affected by this. If you had to give lessons to other people who are now looking at this issue, perhaps more seriously than they have done before, is the really bad issue, and I suppose I'm thinking in some ways about the media industry in this, is that giving top performers more room for maneuver or whatever than people, or more discretion than people thought? Is that top performers need to be treated the same as everybody else?
I think they absolutely need to be held accountable. One of the really valuable lessons that I got early in my life was actually through Jack Welch, and he said, it's very tempting to allow top performers to misbehave in any way, but for me, he was talking about being aligned with the CEO. Sometimes you allow top performers. The tendency is, well, let them get away with some kind of behavior that is not the right behavior because they're so good. And what Jack told me very early on is that it's the top performers who are problematic culturally that are the most dangerous because they have followership within the company, because people look up to them. So he's like the dumb person who is bad culturally. He's not the problem because everyone says, well, that's a dumb person, so who cares? It's the smart person who has followership, so it is incredibly important for the top performers to actually be held to account more radically than anyone else, because they're the ones who have followership at the company, and they have to set the example. So for me personally, that has absolutely guided how I've managed. Expedia was a company that had, excellent cultural values, and one of the first things we did at Uber was to go out and reset our cultural values, and we call them norms, because to me, it's not just these values that you put on the wall and kind of people stare at and it's all nice. It's about behavior. And we set out to change behavior at Uber, and I think that the company was thirsting for it, and we are starting on a path, and I believe it's going to be a positive path.
An inevitable question, I hope you won't regard it as a cheap shot, but you talked about smart people who have followers throughout a company. I mean, Travis would seem to be the epitome of that sort of figure. Do you think of him as being in that category of people that Jack Welch was talking about?
I think, listen, Travis was the CEO of the company, and he had incredible followership, and he was held to account, right? I mean, he's no longer the CEO of the company, and he's a board member. He's a big investor, and so he's absolutely going to play a part on the board. But we've also been very clear as a company that we do have to make a break with the past, with how we behaved as a company. And to some extent with the new CEO being a very different kind of a CEO. So in the end, you have to be held accountable, and I think that Travis was held accountable, and at this point, he's a board member and a constructive one at that.
If you look around the world now, where do you see the next competitors to Uber? You've obviously got Lyft breathing down your neck.
Yes.
Where else do they come from?
Well, I think that as you move into a world of autonomy, the position of the car manufacturers, the position of, for example, Google, who's developing Waymo and Waymo autonomous technology, you're going to get a lot of players interested in this space. And a lot of people think about Uber and ride sharing as a significant enterprise, and it is. But the fact is that we account for less than 1% of miles driven on the road now. When autonomy comes in, that number over the next 10 years is going to be closer, I believe, to 15 to 20%. So because we're not yet a true alternative to car ownership, and I believe that as you bring autonomous and you bring the price of mobility down and make it available to everybody, everywhere, then we become a real alternative to car ownership, and that really opens up the market for us, but it also opens us up to many more competitors.
And is Google at the forefront of those competitors at the moment?
Google is one of many. I think that they've developed very strong autonomous technology, but what we think, which is exceptional, is having autonomous technology and the network under one roof, which allows us to use autonomous in a very practical way, nearer than you think.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Jason Kelly on Bloomberg Radio.
Live from New York and New Jersey, streaming on YouTube, it is Fed Decision Day, Wednesday, September 16th, 2020. And here's a couple of headlines. The Fed on hold until inflation at 2%, set for moderate overshoot, and the Fed to keep rates near zero until they achieve maximum employment, leaving rates near zero as expected. Forecasts show on hold through 2023. Jason Kelly, you want visibility? There you have it.
Yep, they are practicing what they've been preaching in many ways. I think this is the Jay Powell Fed doing a little bit of a turn and saying, listen, we're going to tell you what we're going to do. That moderate overshoot on inflation, again, sort of buttressing some of the case that they've been making in terms of how they're going to think about inflation going forward, which is a big deal.
It's like what inflation? Equity markets, they're moving a little bit higher on this news, but just a little bit change there, mostly unchanged. And if I look at the yield curve, looks like we're not initially seeing too much movement, but we're going to watch for some further analysis as we get through that Fed statement and then, of course, the press conference. First up, let's get to Charlie Pellet.
Right to the numbers, because here's what's going on. We've got the 10-year up 4/32, yield now 0.66%. S&P little changed as those numbers break. Right now we've got the S&P up 10. That's a gain of 0.3%. The Dow up 220, up 0.8%. NASDAQ, though, remaining lower today. Weakness in tech stocks. NASDAQ down 26, drop there of 0.2%. Again, the Fed saying it will keep rates near zero until we achieve maximum employment. We'll have more coming up in just a moment. Gold up 0.6%, $19.65 the ounce, and West Texas Intermediate crude surging now by 4.6%, $40.04. Again, recapping here, S&P higher by 11, up 0.4%, 10-year yield 0.66%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. Jason Kelly, Carol Massar, excuse me.
I believe that's Carol Kaufmasser.
Carol Kaufmasser here with me on a Fed Day. Love the Fed Day. So let's understand what they're talking about. Kathleen Hays, she's with us, Global Economics and Policy Editor for Bloomberg in New York City. Dave Wilson is stocks editor for Bloomberg. He joins us from New Jersey. So, Kathleen, talk to us. Go ahead.
Well, we just want to mention to everybody that Bloomberg Business Week, Focus on the Fed, brought to you by Commonwealth Financial Network. Be the independent advisor you always wanted to be with all the support you need to get there. Visit commonwealth.com to learn more. Take it away, Jason Kelly.
Oh, well, thank you so much for, paying the bills. All right, Kathleen Hays, now that we've got the bills paid, talk to us about what you're seeing and what jumped out at you.
Well, first of all, the fact that the vote was 8-2. 13 of 17 officials forecast rates on hold through 2023. Not surprising, but again, I think it's a little bit surprising to me on the dissent from Rob Kaplan, Neil Kashkari, Minneapolis Fed, Rob Kaplan from the Dallas Fed. Now, remember, there's 12 Fed bank presidents. 4 of them vote on a rotating basis. That's how you get a total of 10 on this vote out of the 17 officials on the Federal Open Market Committee. But importantly, Rob Kaplan preferred to retain, quote, greater policy rate flexibility, while Neil Kashkari dissented because he wanted to wait for a rate hike until core inflation has reached 2% on a sustained basis. I think, one of the criticisms among Fed watchers of what came out of the Jackson Hole virtual meeting, this switch to an inflation targeting framework, et cetera, is how are they going to do it? How much are they going to overshoot? What happens if they overshoot? Then do they have to undershoot? There's so little. It's really spelled out in terms of details. This is so vague. And many of them say, well, it's probably because there's still not a full agreement within the Federal Open Market Committee about how they're going to carry this out. Rob Kaplan, I think, has already said in the past that he would be fine with, in the past year or more, that he'd be fine with letting inflation run hot, or let it run above a bit 2%. But at some point, he'd want to look at that, and then he might change his mind. Has been very worried about the virus. I think he's the dove because the key inflation gauge is not the core inflation gauge, right? So now he's talking about core inflation reaching at 2% on a sustained basis. It's a little stricter, right? So I think is going to be something that comes out of this.
Well, and I'm just going to say what's coming out of it in terms of market reaction. Not much when you look along the yield curve, the 10, 5, and 2, pretty much where they were right before the release of those Fed minutes. Equities, however, we've seen some support, and we are moving to just a little bit higher on those news. Let's bring in Dave Wilson. Dave, give us the equity market reaction here, because we have seen a bit of a turnaround.
I mean, we have, and it kind of started, before the decision was announced, and we saw the S&P 500 kind of pop up for a few minutes. It's given back sort of those initial gains, still trying to hang on, though, for a fourth straight advance. And when you look at the 11 main industry groups in the S&P 500, it's a distinctly sort of economic bent to all this. Energy stocks, industrial stocks, financial stocks, best performers out of those 11 groups. And what they also have in common is they're all down for the year. So it's almost like, to some extent, what we're seeing out of the Fed is giving at least some investors a reason to look at the more beaten down areas of the market. And I say that knowing that there are only 2 groups that are down out of the 11, technology and communication services, which includes Facebook and Google's owner Alphabet and a bunch more sort of internet-linked companies. So, definitely a shift from what we've seen over time in terms of the relative performance industry-wise.
But also areas of the market that have run up a lot, Jason, right?
Yeah, absolutely. So, Kathleen, let's take a step back if we can and just remind people, I mean, the Fed, always important, of course, but it has been many would argue, and I might agree with them, the critical player in the government's response to this pandemic, especially from the market's perspective. So as you see this, and obviously we're going to hear more from Jay Powell coming up in about 24, 25 minutes, remind us the place that the Fed is really holding here in terms of kind of keeping it all together.
Well, let's remember that the Fed very early, I believe it was March 3rd, and that was before there were even lockdowns going on in the United States, made its first emergency rate cut, right? And then it quickly got the rates down to near zero as it launched in total, in the end, 9 different programs to lend money to people, to get money to businesses, to make it easier for them to not lay off workers. And importantly, though, remember how crazy the bond market was in February? That's one of the reasons why I started buying securities, pumping liquidity, right? And they've done an excellent job with all that. Congress, of course, did get on board and pass a big stimulus program, but now it looks like nothing till after the election. So they have played a very important role. And I think the other thing that the Fed is trying to do with all of the stuff it's done lately in terms of this framework, they're just making it so crystal clear. I mean, you wouldn't expect, with all the speeches they've given, everything Jay Powell and others have said, that they were even thinking about hiking rates for a long time.
Right.
But I think more and more they're telling people, hey, we're not going to start hiking rates. We're not going to be, this is not the past where we let inflation rise so much and then say, man, we better cut it off. And I think you have to bring in all the other aspects of this as well. In Jackson Hole, the Fed also added something that caught a lot of people's eyes. It's not just maximum employment the Fed's supporting, massive inclusive employment, because more and more there have been voices saying, look, you've got to let the economy run hot to allow low-income workers, many of them happen to be black, happen to be Latino, allow them to get caught up too. So there's a lot of pieces here, and I think the Fed is clearly on the side of some of the big trends going on in our country and in the world even. I think the question for markets, for investors, and for economists, though, is how this is really going to work as we go down the road.
Yeah, exactly. I'm blown away about, we keep kind of kidding about CEOs and we don't know what's going to happen in 2021 visibility. And I respect that because it's still a lot of questions. But here's the Fed saying, we're going to likely keep rates, forecast, and rates at zero through 2023. Well,
don't you suppose that's why Rob Kaplan said, hey, I'm dissenting, and Rob's a centrist. Rob's a right middle of the road, right down the road guy. And remember, he worked on Wall Street for a long time.
So Kathleen, how often is it that they put out this kind of long-term forecast, but then they come back in a year? I mean, I don't know. 2023 is a long time away. I mean, how likely is it that they're going to revise that?
Carol, let's pretend. I'm going to talk to you like I'm a Fed official. Well, Carol, today I put in my forecast to the dots, and Carol, I'm looking at how the economy looks right now and how I think the virus is going to play out. And we really expect that it's going to take a long time to get unemployment down to a level that we would consider something like maximum and make sure it's inclusive unemployment. Maybe
and I'm going to say, 4%. Hey, Fed official, get real. Pretend we're at a bar and you're really talking to me. Fed official, Kathleen Hays, tell me what you really think. Well, you're going to change this, right?
You know what you would say, Carol? You might say, well, but Kathleen, you guys already missed the fact on unemployment that you thought it was going to be 9.3% at the end of 2020. It's already down to 8.4% as of August. Yeah. What if the economy gets stronger faster? Can you really stick with no rate hike until 2023? And then if you push me hard enough, or one of them, they'd probably say, well, sure, yeah, but we're not, inflation going above 2% isn't the thing that pushes us. It's going to be unemployment falling and getting people back to work, and we're willing to tolerate some overshoot, but that's the question too. How much overshoot?
Yeah, exactly.
Well, I love this role playing. I could just sit here all day and listen to you guys sort of pretend to be Fed officials, and I feel like we've got
on the barfly who's really into the Fed.
This is the show, is role playing the Fed. I just want to play Jay Powell and sort of have a monotone every and not really answer any questions. All right, Kathleen Hays, thank you so much. Dave Wilson, give us a little tease for your chart of the day coming up.
Oh, it's been quite a year. There's a word called dispersion that analysts use to talk about the extent to which stocks or industry groups either track each other or don't. This year is all about don't.
There you go.
I think about some role playing for Dave, too.
Yeah, exactly. I mean, let's be honest. You know who I would actually be playing just because of the baldness? Kashkari.
Oh, come on.
Have to be pretty feisty.
You don't have to look like the person in order to take them on as a role.
You would really be the Jay Powell. All right. Coming up, we've got a really interesting show. Obviously, we're going to lean heavily into what's going on with the Fed. We're going to hear from Jay Powell himself, the real Jay Powell, in about 19 minutes or so.
No
but coming out of that, we are going to hear from Dave Wilson again, as we just mentioned. We're going to get you to the close of trading, but got some big names late in this showcase.
Yeah, I'm looking forward to this. Paul Rather, senior advisory partner at the private equity firm. You have heard of them, KKR, one of the first few employees, in fact, at that iconic private equity firm. But he is involved in some great charity work, philanthropy, and a program that's really making a difference for a lot of minority kids. So we're going to get into that.
And very closely tied to an institution we've gotten to know of late, talking about Trinity College up in Hartford. I have been there with him, and it is impressive to see what he's done for the city and for the campus. So really, really looking forward to catching up with him. And also, this is just a dream interview, for me at least. PJ O'Rourke, I've been reading him for years and years. He's always got a take.
Yeah, and talk about he has so much to take from right now. I mean, there's so much out there to write about. Yeah, nobody is left. I don't want to say unscathed, but
untouched.
Untouched. There you go. Also, we've got a surprising survey on B Schools. As you know, we do these incredible rankings every year. It's one of our best-known franchises at Business Week. This isn't a ranking. This is a survey. And like I said, some surprising results. And as we do every day, Jason, we're talking about getting back to the office. This is one of the most read stories on the Bloomberg.
All right. Well, before we get to any of that and we get back to the Fed, let's get to Nancy Lyons down in D.C. She's got world national headlines. Hey, Nancy.
Thanks, Jason. CDC Director Robert Redfield is insisting to senators there is no truth about political interference in the agency's creation of the Morbidity and Mortality Weekly Report, or MMWR.
At no time has the scientific integrity of the MMWR been compromised. And I can say that under my watch, it will not be compromised.
As for when a vaccine might be broadly available, Redfield says likely in the late second quarter or third quarter of next year. The Senate Homeland Security Committee plans to subpoena some 40 officials who served under President Obama in its investigation of the probe into the Trump campaign's possible Russia connections. Bloomberg's Irv Chapman reports.
Committee Democrats, led by Senator Gary Peters, objected.
This is a partisan fishing expedition.
Chairman Ron Johnson had the backing of his Republicans.
But Democrats seem intent at every turn to frustrate and interfere with our oversight efforts.
Republican Mitt Romney urged that the investigation be limited to actual wrongdoing.
It's very important that the committees of Congress not fall into a increasing pattern that we're seeing, using taxpayer dollars and the power of Congress to do political work.
Romney noted, therefore, that the committee won't be looking into Hunter Biden. In Washington, Irv Chapman, Bloomberg Radio.
The White House is looking like it's willing to increase its offer with Democrats on the next round of stimulus. Chief of Staff Mark Meadows says President Trump is open to the compromised $1.5 trillion proposal from a bipartisan group of House lawmakers called the Problem Solvers Caucus. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg. Back to you, Carol and Jason.
All right, Nancy, thank you so much. You are listening to Bloomberg Business Week. Jason Kelly and Carol Massar. Got another blockbuster team here on deck to help us understand what's going on at the Fed. Dr. Stephen Skanke, of course, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member. He's in Washington, D.C., speaking of the nation's capital. And Jeffrey Cleveland, Chief Economist for Payton and Regal. He joins us on the phone from Los Angeles. Jeffrey, I want to start with you. As you sort of distill this down, nothing seems to be shocking the market about this, but steady as she goes, or what? What do you see here?
Well, I said this is more explicit forward guidance than I think I expected in the statement. The Fed here pledging to keep rates low until inflation is back above 2% for some time and we get to full employment. So I would say that is effectively pledging to keep interest rates at zero for forever, Jason, for the foreseeable future, unless you really expect inflation above 2%. The Fed is at zero. That was already priced in. So I think that's why markets are not reacting much, at least so far. You didn't have a rate hike priced into the bond market until 2024. So that's nothing new. But I think it's interesting to think about, made more explicit that forward guidance than I think most people expected in this particular meeting.
I'm like blown away. Steve Skanke, come on in on this. I'm curious, do you think that this is a political decision, one at least made a little bit with the election in November in mind?
the Fed is obviously disappointed that there hasn't been any action on the fiscal stimulus side of things yet. They've done about all that they can in being specific about that, and they note in their announcement and in the comments of individual FOMC members leading up to the meeting that they remain concerned about the economy and the tremendous human and economic hardship. They once again reiterate their statement from 6 weeks ago. The path of the economy will depend significantly on the course of the virus, and we had daily infections yesterday of 53,000. It's very frustrating for the Fed, and rather say something more about fiscal stimulus. They were just very explicit. They're going to keep rates at zero. They're going to continue their bond buying program at least at the current rate, and implying that they may increase it above $120 billion a month until there's just demonstrable evidence that they're reaching the employment targets, and inflation is averaging above 2% a year for some period of time. It would be hard for them to say more that would be encouraging and positive for the markets.
Okay. Well, and the markets seem to be reacting pretty positively. I mean, now taking a look, Carol, the S&P and the Dow definitely hitting their highs of the day. The NASDAQ creeping very close to there as well. So, Jeffrey Cleveland, I mean, this is a market that I not to be too silly about it, but loves the Fed. They have counted on the Fed throughout this entire crisis.
Well, there is no alternative, right, at this point? I mean, they're pushing people into equities.
Yeah, what's the old adage? Don't fight the Fed. I think that applies. If real rates are going to be maintained at a negative level, so negative T-bill returns, then investors, many of our clients looking elsewhere. So the investment-grade corporate space, the high-yield corporate space, emerging market debt, and equities. There's your alternative if you're looking for income and return. So I think that's still in play. I should also say that, there are risks, of course. One of them that we're worried about is the fiscal relief, the lack thereof, the extension of that. But the data, the economic data, is better than last time the Fed put out their projections. They're much more pessimistic projections from the FOMC in June, and they've marked up their GDP forecast. They've marked down, at least in terms of the unemployment rate, lowering the unemployment rate to 7.6, by the year end. So that's much better than they were anticipating in June. They had it closer to 10%. So things have improved relative to 90 days ago, and I think that's important for the financial markets, because financial markets are always looking ahead.
So what do you guys want to hear from Jay Powell at the bottom of the hour? So just in about 10 minutes' time. Steve, let me start with you. What would it be that you would press the Fed chief on?
To be more explicit, if he can, about what really is the inflation target, and probably even more importantly, Carol, is what it is they're going to do to try to drive it to that. What's left in their arsenal of monetary policy tools, which they say they're going to use to their fullest, to help bring further economic activity that will cause wages to rise and further help increase employment. And following up a little bit about what you asked earlier, this is really, their next meeting is on the eve of the election, and so it's very hard for them to do or say much at their next meeting without sounding political. So Chairman Powell has got to get in all the points he'd like to make in his press conference and exactly what they're going to do in terms of increasing the balance sheet, putting more energy into their emergency loan facilities to get things going in a better way, and especially if we end up with no more fiscal stimulus before the end of the year.
And so, Jeffrey, if you're on Capitol Hill and you're looking at this and you're watching the negotiations or lack thereof go on around fiscal rescue or stimulus, Does this change your thinking at all? I mean, it's hard to say what they're thinking, candidly, at this point, because they can't seem to get a deal done. But how does the fiscal picture match up with what we're hearing on the monetary side?
Well, unfortunately, I think the story was that the consumer was going to completely fall apart in August and September when these benefits ended as of the end of July, and that really hasn't happened. Today, this morning's data for retail sales, the August data, it was a little bit slower than expected. It slowed down from July, but the consumer has not fallen apart. We're remarkably, Jason, back. I think we're 15-16% below where we were in February on restaurant sales. So that's much better than I would have anticipated, given the expiration of the fiscal benefits and the fact that the virus is ongoing. So things have evolved better than some of the worst fears, and so I guess that just makes policymakers, if they already had their heels dug in on the fiscal relief front, they might stay with that position.
I mean, Jeffrey, how does the economy feel right now? I mean, it's really kind of shocking, I feel like, if you think about, how much we went down, how much, we have come off of that low, and yet there are still statistics, some that are promising, some that are troubling. How do you see the economy, especially when we don't have a lot of CEOs who come out and say, here's what we're seeing? Even those CEOs who are in a better place and, God forbid, have kind of benefited from the pandemic. So how do you see the economy for the rest of the year and going into 2021?
Well, the third quarter is looking great, Carol. U.S. and global. We're going to see a GDP annualized rate in excess of 30%, which is good coming off the 30% decline that we saw in Q2. So big bounce in Q3, and by the end of the year, we're still below levels that we started the year. So GDP is probably 3 to 4% below levels, and we'll take another year or two to get back to the pre-virus levels. So strong bounce back, but then we are going to face a little bit of a longer road to get back there, with some uncertainty in the fall, of course.
And Steve, do you agree with that, or what's your assessment here?
I do agree that we should see GDP bounce back at an annualized rate of 30% in the third quarter, and then just continue to move forward. I think one of the challenging things, though, is the difficulty that we've had with some of the employment numbers and unemployment numbers. This began back in March, where the COVID impact on surveys had created a big problem for the way the survey results were coming in. And even when we looked at the August numbers, which were great, all things considered, after tremendous job growth in May and June, there are 15 million people, roughly, who left the labor force. A third of those because they didn't have child care opportunities, and the other two-thirds unsure as to what opportunities there might be. So while I'm really excited about the unemployment rate falling to where it has, compared to where the Fed thought it was going to be, even to the end of the year in the 9 to 10% range, I think we need to be careful to make sure we understand really what's going on in those numbers, so that people, especially policymakers, aren't letting their foot off the gas too soon.
Right. Can I just say, Jason, to you, I still have to get my head around a bounce back of 30%, after a drop of 30%. Like, I just can't even get my head around.
And to that point, and to the point Stephen Skanke was just making, this question of who's affected and how. I mean, Jeffrey, I think about that a lot. I was having a conversation earlier today for a private equity event with David Rubenstein, and we were talking about this K-shaped recovery, and maybe that is or isn't the right way to look at it. But what we do know is that this pandemic has not been indiscriminate economically. We know it has been actually very discriminatory economically. What are the long-term impacts of that, especially given that we even have, maybe I shouldn't say even, but we do have the Fed essentially saying we may let the economy run a little hotter in order to ensure that employment is not just fuller, but fairer?
Well, that was the key part of the forward guidance in the statement, Jason, full employment. So there's some wiggle room around that. Does not mean, in my view, the unemployment rate getting back to 4 or 5%. What they probably are referring to is something more inclusive. So an employment to population ratio. So one that we like to look at is the 25 to 54-year-olds, the core working age population employment to population ratio. That, as of August, was 75, right around there. Pre-COVID, before the pandemic, we were around 80, a little bit above 80. So we have a ways to go until we get back to a more full, inclusive employment. But that would be the metric that I would watch. And the Fed is pledging to keep rates low until that time.
All right. So what keeps you up at night, Steve, when you think about the economy? I mean, you talked about your concerns about policymakers making sure that they are watching and being smart as we read the data. I feel like we have to be really good about digging deeper into statistics right now so that we really understand what's going on. But what is it that keeps you up at night when it comes to the economy?
Well, Carol, it's really that there's overconfidence in how quickly the rebound is coming. The annualized numbers are sort of hard to get our head around, especially when you're talking about a second quarter decline of 32 minus a little bit on an annualized rate. From January to the end of June, the GDP went down about 11%. And we went from a $21 trillion economy to a 19 and change $1 trillion economy and lost a lot of jobs in the meantime. And I just don't think that our data, particularly on jobs, gives us a good picture as to what is happening, and that if we give up too soon, we will contribute to what I think will be permanent and irreparable damage to a big piece of our labor force. And that just takes a long time to come back from. And I understand all the arguments against putting more gas into the economy through fiscal stimulus. But we have something that's just extraordinary, and I believe that it calls for an outsized response, and I hate to see us give up too soon and miss the opportunity that is something that we can't fully recover from except over a long period of time.
Right. All right. Well, our thanks to you both. Really interesting to get both your perspectives, especially as we look ahead to hear from Mr. Powell, Chair Powell himself. Dr. Stephen Skanke, Chief Economic Advisor for Keel Point, former U.S. Treasury and White House National Security Council staff member from D.C., and Jeffrey Cleveland, our pal out in Los Angeles, Chief Economist for Payden and Regal. Carol?
So we're just waiting just about 30 seconds or so. We are anticipating that Jay Powell will begin his press conference and take questions from reporters about the latest decision when it comes to monetary policy. So as soon as he begins speaking, we will take you there live to D.C. Let's just remind everybody the headline at this hour, among our most read, understandably so, Fed wrapping up that meeting and the Fed leaving interest rates near zero, signaling it would hold them there through at least 2023 to help the U.S. economy recover from the coronavirus pandemic. And certainly in absence of more policy, stimulative policy from legislators, that is why we're seeing the Fed do this. Let's take you to Fed Chief Jay Powell in D.C.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide some relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the Federal Open Market Committee and I made some important changes to our policy statement, including an update to our guidance for the likely path of our policy interest rate. Guided by our new statement on longer-run goals and monetary policy strategy that we announced a few weeks ago, these changes clarify our strong commitment over a longer time horizon. Before describing today's policy actions, let me briefly review recent economic developments. Economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interactions, household spending looks to have recovered about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Activity in the housing sector has returned to its level at the beginning of the year, and we are starting to see signs of an improvement in business investment. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, roughly half of the 22 million jobs that were lost in March and April have been regained as many people return to work. The unemployment rate declined over the past 4 months, but remains elevated at 8.4% as of August. Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 7.6% at the end of this year, 5.5% next year, and 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. For some goods, including food, supply constraints have led to notably higher prices, adding to the burden for those struggling with lost income. More broadly, however, weaker demand, especially in sectors that have been most affected by the pandemic, has held down consumer prices. And overall, inflation is running well below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.7% next year and reaches 2% in 2023. As the economy began its recovery, COVID-19 cases, hospitalizations, and deaths also rose. The reimposition of some social distancing restrictions, as well as more cautious behavior by many individuals, have succeeded in slowing the spread of the virus. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on our success in keeping the virus in check. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. The path forward will also depend on the policy actions taken across all parts of the government to provide relief and to support the recovery for as long as needed. The Federal Reserve's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We remain committed to using our full range of tools to support the economy in this challenging time. The changes we made in today's policy statement reflect our strategy to achieve our dual mandate goals by seeking to eliminate shortfalls from maximum employment and achieve inflation that averages 2% over time, as we articulated in our statement on longer-run goals and monetary policy strategy. We view maximum employment as a broad-based and inclusive goal and do not see a high level of employment as posing a policy concern unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. And we believe that achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at our longer-run 2% objective. In turn, well-anchored inflation expectations enhance our ability to meet both our employment and inflation objectives, particularly in the new normal, in which interest rates are closer to their effective lower bound, even in good times. Hence, as we say in our statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take. Of course, as we note in our policy statement, we would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating the damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances such as those we find ourselves in today. These programs serve as a backstop to key credit markets and appear to have restored the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. As I've emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Finally, I would like to take a moment to recognize the passing of our friend and colleague, Thomas Laubach. His outstanding analysis and advice have been indispensable to the FOMC and have played a key role in the policy decisions that will define this era of the Federal Reserve. He will be remembered for his intellect, but also for his kindness, his equanimity, and his dedication to achieving our mission on behalf of the American people. We will miss him. Thank you. I'll now be glad to take your questions.
Thank you. Nick Timrose.
Good afternoon, Chair Powell. Nick Timrose from the Wall Street Journal. You've been very clear about the committee's intentions on rates, not even thinking about raising rates, and today showing low rates even as unemployment falls to 4% and inflation rises to 2%. My question is about asset purchases. Does the guidance today apply to the current asset purchase pace? Are there any macroeconomic conditions under which you would favor increasing the monthly pace of Treasury and MBS purchases? And under what conditions would a decrease in the monthly pace of purchases be appropriate? Thank you.
Thank you. So we say in our post-meeting statement that we'll continue to increase our securities holdings at least at the current pace over coming months to sustain smooth market functioning and help foster accommodative financial conditions. That latter part is an updating of our guidance to reflect what I've been saying in these press conferences for some time and what other central banks have acknowledged, which is that the purchases are fostering accommodative financial conditions as well. That amounts to roughly $80 billion a month of treasuries and $40 billion net per month for MBS. So we do think that these purchases have been effective in restoring orderly market conditions and have supported the flow of credit to households and businesses, including by fostering more accommodative financial conditions, which, of course, we think is a good thing. So in terms of going forward, I would just say this. There are various ways and margins that we can adjust our tools going forward, and we'll continue to monitor developments, and we're prepared to adjust our plans as appropriate.
If I could follow up, I suppose the question I have is why give guidance on one policy tool but not give guidance on the other policy tool when the Fed has talked about those two policy tools working together?
So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity. Now we're buying $120 billion in securities per month across the Treasury curve. That's also adding to accommodation. We do have the flexibility to adjust that tool and the rate tool and other tools as well. But as for right now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
Thank you. Gina?
Hi, Chair Powell. Thank you for taking our questions. Gina Smialek, New York Times. I was wondering, you beefed up your language on financial stability in the long-run statement that you unveiled with your Jackson Hole speech last month. I'm wondering if you could kind of walk us through how you think about financial stability concerns as a factor in guiding future rate increases. Would financial stability concerns on their own be enough to merit changes in the Fed funds rate, or would they have to come in conjunction with an overheating on inflation or some sort of dramatic drop in the unemployment rate? If you could just sort of give us an outline of your thinking there, please.
So what we said in our statement on longer run goals and monetary policy strategy was that the committee's policy decisions reflect its longer run goals, its medium term outlook, and its assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So that's what we said about financial stability. And today we said that we'd be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. But you asked specifically about financial stability. One thing I would say is that monetary policy should not be the first line of defense, is not the first line of defense on financial stability. We look to more appropriate tools in the first instance as a first line of defense, and those would be regulation, supervision, high capital, high liquidity, stress testing, all of those things, macroprudential tools, all of those things are really the first line of defense on financial stability. But we always leave open the idea that we will not ignore those kinds of risks and other kinds of risks more broadly that could impede the attainment of our goals. in setting monetary policy. So that's really how we think about it. But principally that, other tools are the front line, as I mentioned.
But just to follow up quickly, if other tools aren't forthcoming, would financial stability concerns in and of themselves be enough to warrant a rate hike?
So what we said in the longer run in our consensus statement is that we policy decisions reflect the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So the test would be, does a majority of the committee feel that that monetary policy is triggering that, and that would be the test. And it's not something that we've done. We do monitor financial stability concerns, of course, intensely and regularly. We try to use our other tools on them, but we do keep them in mind as we think about monetary policy.
Thank you.
Thank you. Steve Leisman.
Mr. Chairman, I wonder if you could help me understand how the projections of the committee line up with the goals of the committee. You've now altered the projections to the statement to aim for inflation above 2%. But when I look at the SEP, I don't see the committee believe in a single year in the next 4 years that you are ever above 2%. In fact, for each year, you're below it until 2023 was the first time that you actually hit 2%. So do you think, are you confident? Does this suggest the committee is not confident that not only can it not hit its 2% goal, but that now it can't hit its goal of being above 2%?
Not at all. You also don't see people, by and large, lifting off or raising interest rates above zero. I guess there are 4 exceptions out of a committee of 17 during the forecast period. So we don't reach 2%, but we get very close to it in the forecast. We reach 2%. I guess the median is 2% at the end of 2023. So you know what the guidance says. It says that we expect that the current setting of our rates will be what we expect that it will be appropriate until such time as we reach 2% inflation, that we feel that labor market conditions are consistent with our assessment of maximum employment, and that we're on track to achieve inflation moderately above. So that's the test. So I don't think there's any conflict between those two because, the way they're set up, the projections don't show the out years. You ask about confidence, and I would say that this very strong, very powerful guidance shows both our confidence and our determination. It shows our confidence that we can reach this goal and our determination to do so.
I'm sorry if I could just follow up about being simplistic about this, but why wouldn't, if the committee was confident that it could reach its new goal of aiming for inflation above 2%, why wouldn't one of those years at least show inflation being above 2% on the median forecast?
Because we think, looking at everything we know about inflation dynamics in the United States and around the world over recent decades, we expect it will take some time. We expect that the economy will recover quickly now, but that pace will slow as people go back to work, and we'll still have an area of the economy, a big area of the economy that struggles. There'll be slack in the economy. The economy will be below maximum employment, below full demand, and that will tend to put downward pressure on inflation. So we think that once we get up closer to maximum employment, we think that inflation will come back generally, and that's sort of what happened during the last long expansion. It's a slow process, but there is a process there. Inflation does move up over time. We do expect that will continue today, and we expect that our guidance is powerful and will help that outcome. We think that effectively saying that policy will remain highly accommodative until the economy is very far along in its recovery should provide strong support for the economy and get us there sooner rather than later.
Thank you.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. I wanted to ask if you anticipate a slowing in the pace of the recovery if there is not another stimulus package, and specifically if there are particular holes still remaining in the economy that you think could be helped by more aid from Congress. Thanks very much.
Sure. So first, if you look at the summary of economic projections that my colleagues and I filed for this meeting, what you'll see is an expectation that the recovery will continue, that it will continue at a reasonable pace through 2021, 22, and 23. We do expect that pace will slow, just because you would expect that the pace would be fastest right at the beginning of the recovery, because you had such a sharp decline. You would expect that the third quarter should be the fastest gains, and that after that the pace should slow down to a more normal pace. So we do expect that. In terms of fiscal policy, you asked about fiscal policy. So, one thing, I guess I would start by saying that the initial response from fiscal authorities was rapid, it was forceful, and pretty effective. And we're seeing the results of that today in the income and household spending data, in the labor market data, in the construction data, in the data for business equipment spending, and the fact that businesses are staying in business, and the pace of defaults and things like that has really slowed. So there's been a really positive effect. That said, my sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. But I would just say there are still roughly 11 million people still out of work due to the pandemic, and a good part of those people were working in industries that are likely to struggle. Those people may need additional support as they try to find their way and through what will be a difficult time for them. We've also got struggling small businesses, especially those in the business of facing directly to the public. And we have state and local governments dealing with a drop in revenue. At the same time, spending has gone up, much of it related to the pandemic and economic effects. So again, I would say the fiscal support has been essential in the good progress we see now. And finally, I'll note that just about all, the overwhelming majority of private forecasters who project an ongoing recovery are assuming there will be a substantial additional fiscal support.
Thank you. Mike Derby.
Taking a question. Should we expect any further evolutions in forward guidance, say maybe an adoption of something akin to the Evans rule that we had a few years ago, or is there something else that the Fed might be considering in the future?
Well, so we think that the forward guidance we adopted today is appropriate and, as I mentioned, powerful. Effectively, what it says is that we will keep policy where it is now, keep the rate policy where it is now, until unemployment reaches the committee's assessments or levels that are not unemployment, labor market conditions reach levels that are consistent with the committee's assessments of maximum employment, until inflation reaches 2%, and until it's on track to go above 2% moderately for some time. So that's very strong forward guidance, and we think that will be durable guidance that will provide significant support to the economy in coming years. So that's really our thinking on forward guidance on rates.
Thank you. Howard Schneider.
Thanks, Chair Powell, for doing this. Sort of follow up on Mike's question there. Since you described this guidance as durable, you've set up a three-part test here for rate hikes. Levels consistent with assessments of maximum employment. Inflation has risen to 2%, and you're on track to moderately exceed 2% for some time. Each of these have modifiers, and I wonder if you'd explain them a little bit more. How do we pin down assessments of maximum employment? When you say that inflation has risen to 2%, does that mean 2% for a day, a month, 6 months? And when you say on track to moderately exceed, how should we define moderately, and how should we define for some time?
So, as you know, maximum employment is not something that can be reduced to a number the way inflation can. It's a broad range of factors. It really always has been, and really substantial number of factors that we've indicated we would look at. So it's broader labor conditions consistent with our committee's assessment of maximum employment. So that would certainly mean low unemployment. It would mean high labor force participation. It would mean wages. It would be a whole range of things. And we're not looking at a rule. We're looking at a judgmental assessment, which I think we'll be very transparent about as we go forward. In terms of inflation, this is a committee that is both confident and committed to and determined to reach our goals. And the idea that we would look for the quickest way out is it's just not who we are. It's not that there's no message of that here. We would not be looking for 1 month of 2% inflation. We said return to achieve 2% inflation. Okay, so just understand that we're strongly committed to achieving our goals and the overshoot. So that should tell you about that. In terms of so what does moderate means? It means not large. It means not very high above 2%. It means moderate. I think that's a fairly well understood word. In terms of for a time, what it means is not permanently and not for a sustained period. We're resisting the urge to try to create some sort of a rule or a formula here, and I think the public will understand pretty well what we want. It's actually pretty straightforward. We want to achieve inflation that averages 2% over time. And if we do that, inflation expectations will be right at 2%, and that'll help us achieve 2% inflation over time and avoid the situation where the central bank loses its ability to support the economy.
Thank you. James Politi.
Thanks for taking the question. James Politi with the Financial Times. Do you consider today's enhanced forward guidance to have actual accommodation to the U.S. economy from a monetary perspective, and sort of delivered further support for the economy, or is it just a tweak to your existing policy stance? And in terms of fiscal support, do you assume in your own projections, not just the private forecasters, that additional fiscal support will be forthcoming, or do you expect a weaker growth or a larger contraction rather this year if no fiscal support is forthcoming?
So in terms of the effects, so I think what we've done is more or less aligned with the consensus statement today. So it's in line with what might have been expected. As I mentioned, I think over time it will provide very powerful support for this economy as we move forward. In a sense, it's consistent with expectations. So I'm not looking for a big reaction right now, but I think over time, again, guidance that we expect to retain the current stance until the economy has moved very far toward our goals is a strong and powerful thing. And I think that will be supportive of the economy over time. In terms of additional fiscal support, I guess your question is what would happen if, people have different assessments, and different participants in the FOMC made different assessments on their own. I think broadly, though, there is an expectation among private forecasters and among FOMC participants that there will be some further fiscal action, and there does seem to be an appetite on the part of all the relevant players to doing something. The question is how much and when. And so I would just say that if, and it's very hard to say, that so far the economy has proven resilient to the lapsing of the CARES Act unemployment, enhanced unemployment benefits. But there's certainly a risk, though, that those who are unemployed appear to have saved some of those benefits, and they'll now spend them. And that as the months pass, if there's no follow-up on that, if there isn't additional support, and there isn't a job for some of those people who are from industries where it's going to be very hard to find new work, then that will start to show up in economic activity. It'll also show up in things like evictions and foreclosures and things that will scar and damage the economy. So that's a downside risk. So I think the real question is when and how much and what will be the contents. And no one has any certainty around that. But broadly speaking, if we don't get that, then there would certainly be downside risks certainly through the channel I mentioned.
Thank you. Anakin, CNN.
Thanks for taking my question. Chairman Powell, given the recent update to the policy framework and repeated calls for this in the Fed Listens event, is the Fed open to other measures of the economy, such as income inequality and affordability of housing?
So we monitor everything we think is important in the U.S. economy. And in a broad sense, all of it goes into thinking about monetary policy. You mentioned inequality. So, disparities in income and in financial well-being by various demographic and racial categories is something we monitor carefully. Inequality, which I would point to, it's a multifaceted thing, but I would point to the relative stagnation of incomes for people at the lower end of the income spectrum and also lower mobility. So those are things that hold back our economy. They are. The thing is, we don't really have the tools to address those. We have interest rates and bank supervision and financial stability policy and things like that, but we can't get at those things through our tools. When we lower the federal funds rate, that supports the economy across a broad range of people and activities, but we don't have the ability to target particular groups. Notwithstanding that, we do talk about it because these are important features of our economy, and I think those distributional issues are issues that are really for our elected officials. And I would say I take them seriously as holding back our economy. The productive capacity of the economy is limited when not everyone has the opportunity, has the educational background, and the health care and all the things that you need to be an active participant in our workforce. So I think we can, if we want to have the highest potential output and the best output for our economy, we need that prosperity to be very broadly spread in the longer run. And I would just say the Fed, we can talk about those things a lot. And when we think about maximum employment in particular, we do look at individual groups. So the high unemployment in a particular racial group like African Americans, when we would look at that as we think about whether we're really at maximum employment. We would look at that along with a lot of other data. So the answer is we do look at all those things and do what we can with our tools, but ultimately these are issues for elected representatives.
Thank you. Edward Lawrence.
Yeah, thank you, Chairman Powell, for the question. I just wanted some clarity here. At what point do you think it's prudent to shift the bond purchases from market stability, as you had said, from the shorter-term maturities to more longer-term, more stimulus-related?
So, we think that our asset purchases are doing both those things today. We think clearly there's been great progress in terms of market function. If you remember early in the spring when the acute phase of the pandemic hit, market function was very low, and it's improved rapidly and in many respects is in a good place now. We also, though, think that these asset purchases, which total $120 billion a month, which is much larger than for example, the last asset purchase program during the global financial crisis and the recovery therefrom. We think that that's also providing accommodative financial conditions and supporting growth, and we think that's fine. We're also aware that there are ways we can adjust that, to do various things, make it smaller, make it larger, and also target different sectors of the curve. And we're going to continue to monitor developments, and we're prepared to adjust our plans as appropriate.
Thank you. Victoria. Victoria Guida.
Hi, thanks for taking my question. I wanted to ask about a couple of things. First of all, if we don't get a vaccine until well into next year, what does that mean for the economy? And then somewhat related, I was wondering if you could provide any more detail about the stress scenarios that you all are going to release for the big banks and whether that is going to be another full-blown stress test, whether we're going to publicly see those results and what it might mean for bank payouts.
Great. So on the first one, what's happening is basically we're learning to live with, right now, we're learning to live with COVID, which still spreads. And we're learning to engage in economic activity. All of this recovery that we've seen is in a context where, where people are still at risk of catching it. And yet we're able to resume lots and lots of economic activities. And that involves, as I mentioned, I think the more social distancing we can preserve as we go back into the workforce, wearing masks, keeping our distance, that kind of thing, the better we'll be able to get economic activity back up close to where it was. I do think, though, there are areas of the economy that are just going to really struggle until we have a vaccine that's in wide usage and is widely trusted. And those are the ones where people were getting really close together. I also think testing, to the extent you have cheap and rapid testing, you can do a lot with that in the workforce. You can build confidence in the workforce if you have very regular testing. It doesn't cost very much, and you get the results really quickly. If you do that, you'll be able to open a lot of workforces, particularly in cities where the overall case numbers are quite low, and that will help a lot. So I think we're going to be finding lots and lots of ways to get out towards, as far as we can. There's always going to be that for some time. There's going to be certain activities that will be hard to resume. So I think that's the only way I can say it. And I think trying to, when we make a forecast, we make assessments about that. But it's really hard to say. There's no template here. There's no, there's no experience with this. So frankly, for the last 60 days or so, the economy's recovered faster than expected. And that may continue or not. We just don't know. And I think we should do those things that we control to make sure that we can recover as quickly as possible. And the main thing, again, is wearing a mask and keeping your distance while you're in the workforce. That's something we can all do that will limit the spread and let people go back to work, avoid major outbreaks and things like that. In terms of the stress test, so I really don't have any, we're getting ready quite soon to be making announcements and saying things publicly. There's not much I can say with you. Nothing really that I can say that's on that today. I don't have anything for you.
Thank you. Chris Condon.
Thank you, Michelle. Good afternoon, Chairman Powell. You have emphasized many times, including today, that the Fed can only lend and not spend, and sometimes the latter is what's really needed. But to the extent that a $600 billion lending program for small and mid-sized companies could help, what exactly is wrong with the design or function of the Main Street lending program, which has purchased just, I think, $1.4 billion in loans so far? Eric Rosengren at the Boston Fed said recently that Congress should clarify how much risk it wants the program to take. But Congress has already appropriated substantial funds for the 13-3 programs, and these are funds that are explicitly designed to absorb losses. Meanwhile, my colleagues who cover the banking sector say they're being told by commercial banks that the Treasury Department is advising them to target zero losses in Main Street program loans. So, if I may, why is it that the Federal Reserve, the Congress, and the Treasury apparently cannot agree on a loss tolerance that should be applied to the Main Street lending program in a way that would allow badly needed credit to reach these companies? Thank you.
Sure. So a couple things about Main Street. It reaches the whole nation. It's got more than half of the banking industry assets signed up among the banks that are part of it. And it's making loans. The number's more like, it's close to $2 billion now. So the numbers are going up. Banks are joining. Borrowers are coming. And it's significant. It's relatively small now, but it can scale up in response to economic conditions should that be appropriate. If you look out in the lending world, surveys generally find that firms are not citing credit constraints as a top problem, and that is a lot of PPP, bank credit lines, and syndicated loans. There's a lot of credit being let out there. But you're right. We are looking at some things. We're looking at some lenders are concerned about the underwriting expectations. So banks are going to, their approach is likely to be that they're going to underwrite this loan roughly the same as they underwrite any loan. They're keeping part of it. And, what we want to do is make sure that that they know that they should take the payment deferrals and other things in place, and also that it's really a facility for companies or borrowers that don't have access to regular way borrowing now. Otherwise, why would we need Main Street? So that's what we're working on, and we'll be doing we'll be making some changes in that respect. I saw what President Rosengren said. I can't really comment directly on that. I just would say that this is 13.3. If you look at the law under Section 13.3, it's very clear that we are to make loans only to solvent borrowers, and the CARES Act is quite specific in keeping all of the terms of Section 13.3 in effect, including the requirement that we, gather good evidence that the borrower is solvent. This law was amended in Dodd-Frank, and the idea was to make it challenging and put hurdles in place before we made loans. What at the time the thinking was to banks. So now we're using that same law for smaller business borrowers, and it's not a perfect fit. And I would also just say for many borrowers, they're in a situation where their business is still relatively shut down, and they won't be able to service a loan, and so they may need more fiscal support. Having said that, we're continuing to work to improve Main Street, to make it more broadly available, make it available pretty much to any company that needs it and that can service a loan.
Could you just very briefly address the reports that the Treasury is advising banks to target zero losses? Is that appropriate?
I can't say. I don't know about that. I haven't heard those reports. Again, if you think about it, we're going to have to go through the banking system to do this. We're not going to have 100,000 or 1 million loan officers working for the Fed and the Treasury. So we're going to go through the banking system. And the banks like to make good loans. That's what they do. They're trained to make good loans. So you should expect that we expect that they will do some underwriting. We also want them to take some risk, obviously, because that was the point of it. And the question is, how do you dial that in? It's not an easy thing to do. And we're getting some loans made, and we're hopeful that we'll clarify this, and that credit will continue to flow.
Thank you. Chris Rugaber.
Hi, thanks for taking my question. Chair Powell, you've talked a couple of times about parts of the economy that may not recover as fast as we've seen so far. Presumably you're referring to, airlines, hotels, other sections, parts of the economy that rely on close contact. How are you thinking about that in terms of its overall impact? Is that sector large enough to, say, keep unemployment above, far above your maximum goals? Are you expecting that to come back with a vaccine, or are a lot of those folks going to have to find, new jobs and new industries? And should we expect the Fed will keep rates at zero until all of that reallocation is done? Thank you.
Yeah, of course we can't be really sure we know the answers to those questions, but I would say the likely path is that the expansion will continue. And it's, as I said, it's well along, and it'll move most easily through the parts of the economy. It'll still take some time, but the parts of the economy that weren't exactly directly affected, that didn't involve getting people in large groups together to feed them, to fly them around, to put them in hotels, do entertainment, things like that. Those are going to be the places that are very challenging. So there will also be the places that are affected that way, and that's going to be challenging for some time. It just is, and we don't really know how long that will be. It's millions of people. As I mentioned, we had 11 million, something like 11 million people in the payroll survey have gone back to work out of 22 million who lost their jobs in March and April. So that's half of them. So 11 million, particularly if the pace of returning to work slows down, it's going to leave a large group of people, and it'll be very meaningful from a macroeconomic standpoint. And our commitment is not to forget those people. As I mentioned, we want, the sense of our forward guidance is that policy will remain, as we've said, highly accommodative until the expansion is well along, really very close to our goals. And even after, if we do lift off, we will keep policy accommodative until we actually have a moderate overshoot of inflation for some time. So those are powerful commitments that we think will support the full recovery, including those people, as long as it takes.
Thank you. Mike McKee?
Mr. Chairman, Michael McKee from Bloomberg Radio and Television. Based on what you were just saying about keeping policy accommodative for a very long time into the recovery, lower for longer, as far out as 3 years in your latest projections, is that basically it for the Fed? In other words, since interest rates are your main tool, the things you can do would push down on interest rates. But is it the case now that the only additional stimulus that can come to the economy is from the fiscal side?
Well, no, I wouldn't. I certainly would not say that we're out of ammo. Not at all. So, first of all, we do have lots of tools. We've got the lending tools, we've got the balance sheet, and we've got further forward guidance. So there's still plenty more that we can do. We do think that our rate policy stance is an appropriate one to support the economy. We think it's powerful, and as I mentioned, this is the kind of guidance that will provide support for the economy over time. The idea being that policy will remain highly accommodative until the recovery is well along, really very close to our goals, and then will remain accommodative even after we lift off. So I think that's a really strong place for rate policy to be. But again, we have the other margins that we can still use. So no, certainly we're not out of ammo.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago and more when the Fed first started doing QE. And I would say if you look at the long experience of the 10-year, 8-month expansion, the longest in our recorded history, it included an awful lot of quantitative easing and low rates for 7 years. And I would say it was notable for the lack of the emergence of some sort of a financial bubble, a housing bubble, or some kind of a bubble, the popping of which could threaten the expansion. That didn't happen. And frankly, it hasn't really happened around the world since then. That doesn't mean that it won't happen, of course it's something that we monitor carefully. After the financial crisis, we started a whole division of the Fed to focus on financial stability. We look at it from every perspective. The FOMC gets briefed on a quarterly basis. At the board here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is a particularly tight one. So, but again, we won't be just assuming that. We'll be checking carefully as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
Thank you. Don Lee?
Chair Powell, I'd like to ask you about the labor market. As you know, in August, there were about 30 million persons claiming unemployment benefits. Yet the BLS jobs report for August showed about 13.5 million unemployed, only about 6 million more than before the pandemic. I wonder how you reconcile that and what you think the actual labor market conditions are.
So, I think the overall picture, take a step back from this, the overall picture is clear, and that is that the labor market has been recovering, but that it's a long way from maximum employment. I think that's the bottom line on it. So within that, though, take claims in particular, the number of claims, the quantity of claims, and frankly the fact that PUA claims are new. The pandemic unemployment assistance claims, that's a new system that had to be set up. The actual counting of the claims is volatile, and it's very difficult to take much signal about the particular level. So, because people were setting those systems up, and when they got them set up, they counted them all at once and things like that. I think, though, what you've seen is that the level of, certainly the level of initial claims has declined very sharply from the very high levels of March and April, and is now at a lower level, continues either to be flat or gradually decline. It's worth noting, and that's good, it's worth noting that that level is maybe 5 times the level of what claims were. Claims were around 200,000. Now they're 900,000 in that range weekly for initial claims. So that just tells you the labor market has improved, but it's a long, long way from maximum employment, and it will be some time getting back there. I think that's the best way to think about it. In many parts of the economy, there's just a lot of disruption, and it's really hard to say precisely where we are. I'll give you another example. With we say unemployment's 8.4%, but if you count those who are misidentified as employed when they're actually unemployed, and you add back some part of the participation number. So if you had a job and you were in the labor force in February and you lost it because of the pandemic, some of you are now being reported as out of the labor force. But I would more look at those people as unemployed. If you add those back, the level of unemployment is probably 3% higher. On the other hand, by that metric, the unemployment rate would have been in the 20s in April. So the improvement has been quite substantial under any measurement, but the level is still quite high.
Well, if I could follow up, is it the Fed's aim to get back to 3.5% or even lower?
Yes, absolutely. I can't be precise about a particular number, but let me just say there was a lot to like about 3.5% unemployment. It's not a magic number. No one would say that number is the touchstone, or that is, maximum employment. I would just say you ask about 3.5%. A 3.5% unemployment rate showed, gains being shared very widely across the income spectrum. In fact, going more to people at the bottom end of the spectrum. It showed labor force participation coming up above many estimates of its trend, as people who'd been out of the labor force were being pulled into a tight job market. There's a lot to like about a tight job market, particularly in a world where we didn't see inflation. So yes, we'd love to get back to that. I mean, I'd say we would like to get back, rather than to a particular number, we'd like to get back to a strong labor market where wages are moving up, where people can find work, where labor force participation is holding up nicely. That's what we really love to get back to. Now, of course, we need inflation to perform in line with our framework. But the good news is we think we can have quite low unemployment without raising troubling inflation.
Thank you. Nancy Marshall-Genzer.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to follow up on the wealth gap issue. I know you were saying that you have limited tools, but are there things that you can do possibly in the area of research and maybe expand your research on racial economic gaps?
We do. We are gifted with a substantial group of researchers who really cover the waterfront, and we do a significant amount of research on racial disparities across multiple variables, including wealth, as you ask about. So we do that, and we also remember we have our Division of Consumer and Community Affairs, which is present in communities around the country, and the reserve banks all have very active community affairs groups. They're present in communities around the country. So it wasn't just the Fed Listens events. It's more just over a long period of time we are in contact with people in those communities to understand their experience of the economy. We serve all Americans, and we know that, and we're going to use our tools to reflect that fact. So the answer is yes, we do quite a bit of research, and I suppose we could do more, but we really do a lot, and we contribute to those fields and those assessments of of the state of the economy. And we do that not just because it's interesting and important, but because it's important for the economy and important for our mandate. We are assigned maximum employment. Now, what does that mean? As I mentioned earlier, it doesn't mean a particular headline unemployment number. What it means is maximum employment. So, we look at that in many, many different variables, and we ask ourselves whether those variables or those labor market conditions are consistent with our assessments of what would constitute maximum employment. And that would include all of the things that we're talking about.
Thank you. Greg Robb.
Hi, Greg Robb from Market Watch. Thanks for this. I want to go back to the new forward guidance that you have. And you say that it's powerful, but you've already had two dissenting voters on it. And I was wondering if there's other people who argued against it. And what do you say to the two who dissented? It looks like President Kashkari wanted a simpler forward guidance, and President Kaplan thought that the current guidance you have was fine for now. So, how did you argue back on those arguments? Thank you.
I wouldn't. I don't want to comment particularly on the two dissenters, but they dissented from, of course, different perspectives, and that should be clear. That's they're not. They're sort of on two sides of the discussion. But I would say this, I am blessed with having a committee of highly thoughtful people who bring diverse life experiences and diverse careers and, of course, diverse views to our work. And I wouldn't have it any other way. I wouldn't. So I would just say in our discussions the last couple of days, the whole committee, everybody on the committee, is very supportive of the Statement on Longer Run Goals and Monetary Policy Strategy and what's in there. Very, very broad support, unanimous support for that. Everyone sees the changes in the underlying economy and sees in their own way the need to address those, and including the changes we made to the employment mandate and to inflation, so that we're now flexible average inflation targeting. Of course, there would be. We're the first major central bank to adopt this framework. There's no cookbook. And this is the first guidance under our new framework. So, of course, there would be a wide range of views, and you would expect that. And it's actually a healthy thing. So I welcome that discussion. I would also say this, this is all about credibility, and we understand perfectly that we have to earn credibility. This facility, this framework we have to support it with our actions. And I think today is a very good first step in doing that. It is strong, powerful guidance. It ties in very nicely with the Statement of Longer Run Goals and Monetary Policy Strategy. We had quite a robust discussion. There are different ideas on how to do this, but that's just the way it is when you have a diverse group of highly thoughtful and effective people. And so I'm pleased with where it came out.
Thank you. Hannah Lang.
Hi, Chair Powell. Thanks so much for my question. I wanted to ask about commercial real estate. I know you had mentioned before you weren't sure if there was a way the Fed could support CRE borrowers, but I was just wondering if you've had any other continuing discussions on that, and if there's any potential way that the Fed could step in that area.
So thank you for that question. We've actually spent quite a bit of time on this, as Secretary Mnuchin, I think, mentioned the other day. And I'll say just a couple of things. First, our facilities are essentially always, they have to be under the law, broad-based and not so much targeting any single sector. Also, it's important to remember that CRE, commercial real estate, benefits from several of our existing facilities. So the TALF takes commercial mortgage-backed securities and SBA commercial real estate deals, and the New York Fed purchases agency CMBSs directly. In addition, I would say Main Street helps businesses pay their rent. So we're helping real estate, in a number of other ways, commercial real estate. Also, CMBS issuance has resumed. Spreads have tightened on CMBS. There are a couple of issues. One is just that commercial properties with CMBS loans often have covenants, uniformly, I think, have covenants that forbid them to take on more debt. So you have a situation, where you, without a legal change or some kind of an innovation that defies discovery so far, you have a hard time providing mass relief with regard to real estate that's in commercial mortgage-backed securities. So we're still working on it. We're still looking. I would say it may be that further support for commercial real estate will require further action from Congress.
For the last question, we'll go to Brian Chung.
Hi, Chairman Powell. So it seems like a lot of the new inflation framework is about shaping inflation expectations, but the average American that might be watching this might be confused as to why the Fed is overshooting inflation. So what's your explanation to Main Street, to average people, what the Fed is trying to do here, and what the outcome would be for those on Main Street? Thanks.
It's a very, very important question, and I actually spoke about that in my Jackson Hole remarks a couple weeks ago. It's not intuitive to people. It is intuitive that high inflation is a bad thing. It's less intuitive that inflation can be too low. And the way I would explain it is that inflation that's too low will mean that interest rates are lower. There's an expectation of future inflation that's built into every interest rate, right? And to the extent inflation gets lower and lower and lower, interest rates get lower and lower, and then the Fed will have less room to cut rates to support the economy. And this isn't some idle, academic theory. This is what's happening all over the world. If you look at many, many large jurisdictions around the world, you are seeing that phenomenon. So we want inflation to be 2%, and we want it to average 2%. So if inflation averages 2%, the public will expect that, and that'll be what's built into interest rates. And that's all we want. So we're not looking to have high inflation. We just want inflation to average 2%. And that means that, in a downturn these days, what happens is inflation, as has happened now, it moves down well below 2%. And that means that we've said we would like to see, and we will conduct policies so that inflation moves for some time moderately above 2%. So these won't be large overshoots, and they won't be permanent, but to help anchor inflation expectations at 2%. So yes, it's a challenging concept for a lot of people, but nonetheless, the economic importance of it is large. And those are the people we're serving, and we serve them best if we can actually achieve average 2% inflation, we believe, and that's why we changed our framework.
Thank you very
Thanks
much.
very much.
All right, you've been listening to Fed Chief Jay Powell, that live press conference, going a little bit longer than he normally has.
Hour plus.
Yeah, he went long last time as well. Typically, he has been wrapping up around 3:15, 3:20. Last time a little bit longer, and this time going past 3:30. A lot of questions. I don't know what the takeaway was for you, Jason, following that Fed decision, but for me, it was just a reminder that, getting back, what he wants is getting back to a strong labor market, and just says it's going to take some time for us to really get to that point. He talked about the expansion continuing, it's moving along, but there are challenges. And he says if the pace of things slows down, you can't forget those